Hey, I'm Brad Smith alongside Madison Mills this morning. This is Yahoo Finance's flagship show, The Morning Brief.
That's right. Looking at stock futures, they are moving higher as investors are looking for more cues on the timing of potential interest rate cuts to come and key labor market data this holiday shortened week. Investors looking ahead to the second half of 2024 and what the third quarter will bring. So let's get to it with the three things you need to know this Monday morning. We've got Yahoo Finance's Josh Schaefer, Jared Blickery, and Josh Lipton with more.
Hey, Maddie, stock futures in the green to kick off the third quarter and second half of 2024. The S&P 500 entering Q3 up 14.5% so far this year, while the tech-heavy NASDAQ composite has rallied more than 18%. The Dow, however, has gained a more modest 3.8% in the first 6 months of the year. Midway through the year, more than two-thirds of the S&P 500 gains have come from NVIDIA, Apple, Alphabet, Microsoft, Amazon, Meta, and Broadcom. NVIDIA alone has driven nearly one-third of these gains.
Plus, Boeing has agreed to buy longtime supplier Spirit AeroSystems in an effort to help resolve its recent safety and manufacturing concerns. In a press release, Boeing said it will pay $4.7 billion or $37.25 per share for Spirit AeroSystems. As part of the deal, Boeing is going to work with Spirit to ensure the continuity of operation support of Spirit's customers and also the programs that it acquires. This comes as the Department of Justice plans to criminally charge Boeing with fraud over two fatal crashes that took place more than 5 years ago. The DOJ asking the plane maker to plead guilty or face a trial, reports say.
And shares of Chewy surging 11% this morning. That is after famed meme investor Keith Gill, known as Roaring Kitty, disclosed a 6.6% stake in the pet retailer. The disclosure with the U.S. Securities and Exchange Commission reveals Gill owns about 9 million shares, which is worth approximately $245 million since Friday's closing price.
Happy July 1st, everyone. Our top story today, stock futures rising on the first trading day of the second half of the year, the first trading day of the third quarter of this year, and across Wall Street. Of course, analysts are discussing the investment themes for the next 6 months. We have our own three themes that we're watching for you today, starting with big tech here, and an undeniable thread has been the excitement around AI, led by NVIDIA, pushing the S&P 500 up 14% and the NASDAQ composite up 18% in the first half of the year. Here in studio with more, we've got Yahoo Finance's Josh Schaefer. Hey, Josh.
Hey guys, yes, I picked tech as sort of the one thing I'm watching going into the second half of the year, really specifically kind of the fundamental story of tech and the earnings, right? Because yes, we've talked ad nauseum about this big tech rally and how it's been all big tech, right? You look at the S&P 500 this year, more than two-thirds of the gains coming from essentially the 6 companies we always talk about. I'm taking Tesla out of that Mag 7 group, and you're talking about companies like NVIDIA, Apple, Amazon, Meta, et cetera. And really, it's been driven by earnings growth, though. And so to me, the largest story I'm watching, and a lot of strategists that I've talked to are watching going into the second half of the year, is just, does big tech continue to outperform in earnings? Because that is a reason that they have driven the rally. It's also a reason the S&P 500 came out of an earnings slump, right? We were in an earnings recession, and essentially big tech by itself carried it out. You look at Q2 earnings coming up to kick us off to start the second half of the year. Revisions, we highlighted this in our morning newsletter this morning as our chart of the day. You can see there, this is a chart from UBS. The top 6 tech plus, which is again those companies I was just naming, are what is keeping revisions from falling for the second quarter. So still right now, you're looking at a largely just big tech exceptionalism story. Do the others actually catch up? Do we get some earnings growth from the other sectors and the other companies? I think is maybe the largest looming fundamental story for the market rally.
Absolutely. It's a yes and, right? We need not only the AI rally to keep this market up, but we also need to see perhaps a little bit of a broadening. Another stat to join your slew of stats there, Josh, that I saw this morning. The top 10 companies are having a 35% growth on market cap, but only a 23% growth in earnings. And at what point does that start to be a concern, that the earnings maybe aren't justifying the market caps for some of these big companies? Another thing, guys, that I am looking at for the second half of this year here is inflation. and of course, the rate cut cycle to come that investors are pricing in now. 2 cuts, that is despite the Federal Reserve and policy and Fed speak indicating only 1 cut to come for this year. I think about what we heard from Stuart Kaiser last week when he was on our show, just the idea that you have to really be looking at the jobs market, and that is because we are starting to see jobless claims creeping higher just ever so slightly here. What does that mean moving forward? Do we start to get a feeling of increasing volatility underneath the surface of some of the data that we're seeing that indicates a potential for that soft landing to become a hard one? Or I was talking to Rick Newman this morning, and he was saying inflation is at a place where if you just don't touch it, if you don't look and close your eyes, in a year we'll be at that 2 handle that the Federal Reserve is looking for. So that's what I'm going to be looking at for this year, both the jobs data in particular to indicate where the economy is heading, and also, of course, those rate cuts to come for the Fed.
Well, look no further to this week than for more of that jobs data. Of course, you're going to get that ADP private payrolls Wednesday, and then, of course, we're going to be looking out to this Friday for that jobs report, the employment situation from the BLS, everybody's favorite statisticians out there. And anyway, one of the other major things that I'm keeping tabs on, and that we all are, in the second half of the year, we're watching the U.S. election here, and particularly after that first debate. Now, without kind of going into and kind of reprising exactly what we heard during the first debate, because there are potentially going to be more debates in the future, we will see there. I'm thinking back to what UBS is putting in their election watch right now and the scenarios that they're seeing playing out. And they did say that the election is likely to trigger market volatility. They think investors should manage risks accordingly, of course, here. But here's particularly what it could imply. In equities, the U.S. consumer discretionary and renewable sectors could be vulnerable in the scenario of a Republican sweep of both the House and Congress, well, White House and Congress. And then at the same time, they think financials would stand to benefit in that scenario. Now, you think about some of the other scenarios that they're continuing to look at and where they're kind of looking at some of the hedges potentially going forward in their own investment portfolio thesis. One of the huge things that they continue to kind of lean on right now, they think investors should hedge risks in sensitive stocks and sectors, and they think that gold can act as an effective hedge against fears of geopolitical polarization, inflation, or excessive deficits too.
I mean, the election, Brad, obviously is one thing that it seems like a known at this point.
Yeah.
But the volatility that we just haven't had at all this year, I think, is kind of the key, right? When if we're splitting this into first half, second half, the VIX basically went nowhere for 6 months. So if it goes somewhere in the second half of the year, you would think at some point maybe we're going to get a little bit of volatility that will impact the market there. Maddie, going back to the inflation story a little bit, it's interesting to me. Doesn't it feel like we came back to where we started the year, where everyone or most people are just kind of comfortable now? You were referencing like just don't look at it and maybe it will just go down. I feel like we went through that hard 3 months and now we're entering the second half of the year back with, well, inflation is just coming down. It will just be, I don't know how fast it's going to come down, but it's just going to come down. And I think if that isn't the case, that's sort of an interesting risk to the rally.
And seeing the transition, too, from guests who used to really dig into which exact moment the Fed was going to choose to cut, those same people now coming on our show and saying it doesn't really matter if it's September or December. That is a huge shift in the commentary from these same people.
Well, just the fact that they're speaking specifically about September or December, there's nothing that they're talking about with November, and the election plays a role in that as well, with a Fed that wants to seem or come off as apolitical as possible here. Historically, that has been the case. Of course, this is a different environment, as they all are, for the Fed to navigate through here. All right. Thanks so much, Josh, for joining us on that. Chewy shares, we're also tracking that this morning. Chewy shares surging this morning after Keith Gill, known as Roaring Kitty, disclosed a 6.6% stake in the stock. This comes after Gill posted a vague picture of a dog to his X account last week, which sent shares of Chewy to a one-year high. All right, Josh, stick around with us for this one, why don't you? Because this has a lot, and I mean, even the SEC filing was perhaps unlike any we've ever seen before at this juncture.
Yeah, so he filed, he had an SEC filing because he bought more than 5% of Chewy's outstanding shares, right, 6.6%. And really, there wasn't much in this filing, Brad, other than Keith Gill decided to add a little checkbox for himself to tell us if he identifies as a cat or not. For reference, you can see on your screen there, he identified himself as not a cat.
Not a cat.
So that was sort of the highlight of how the filing works. Obviously, this is, I think, broader takeaways here. One, there was actually an SEC filing this time with his name on it, saying that he bought a large amount of Chewy shares. That is not something you have seen with a lot of the GameStop transactions he's been making, right? It's sort of been vague screenshots that go up on a Reddit that has been linked to him. But there was kind of discussion when we think back to the GameStop rally over the last month and a half. Is this really Keith Gill? Is he the one on the Roaring Kitty account? Is he the one on his Reddit account? This is clearly Keith Gill because it's an SEC filing.
Right.
He definitely bought the shares. Why he bought the shares, I think, is up to anyone's guess at this point. It is interesting to me, I think, and important to point out, Chewy is a much different company than GameStop.
Yeah.
Chewy has an actual potential re-emerging growth story there, and they posted a positive profit in their most recent quarter. Like, it's just a different company than GameStop. It's not really a meme stock. Like, yes, their founder, Ryan Cohen, is, of course, the CEO of GameStop, and that's kind of your meme stock connection. But Ryan Cohen is not on the board. He does not have any public-facing involvement with Chewy. So just sort of speculating on why this would be the target, it becomes a little bit harder, I think, to put the pieces together, at least for me.
Well, there's an indication, too, that with GameStop the first time around, he did kind of suss out something that the rest of the street was missing. This time around, that's not necessarily clear. So maybe a diversification of the assets there, Josh.
Maybe he just likes the stock, right?
Maybe he likes
just like GameStop stock. Maybe he just likes Chewy stock.
Maybe he just likes Chewy. But having said that, he's also got a lot on his plate right now because Keith Gill also got hit with a class action lawsuit. Josh, tell me what we know at this point about this lawsuit over alleged kind of pump and dumping of the GME stock.
Yeah, so it's a class action lawsuit from someone that says they were impacted by the, quote, pump and dump of GameStop. And essentially it alleges things that you would think it would allege of Keith Gill over the last month and a half. It alleges that he was involved in essentially potentially manipulating the market. He knows that he has power over what GameStop stock or what he can do to GameStop stock, and it goes through a long list. It's a 40-page filing that goes through all the different times that Keith Gill has posted, the market reaction, and it does get, again, deeply into other sources citing that he might be able to manipulate the market. This is something that people have been speculating about since Keith Gill reemerged, was that eventually a filing like this or a lawsuit could come. So interesting to see that come. Should note GameStop shares dropped about 7% in pre-market trading as this sort of started circulating. And so I think the broader question as we come out of this is, for one, it's just a lawsuit filing for now, right? We don't know much more than that. He has not publicly responded to it. But will it take the meme crowd either away from Keith Gill or more toward Keith Gill as real action starts to come against him? I think is the interesting question to watch moving forward is, are people going to say, oh, whoa, I don't really know what's going on here, I want to back away? Or are the hodlers really into supporting Keith Gill, and do they sort of pile in to support him in this effort? I think is probably the most interesting thing to watch over the next couple of days with these shares.
And if history tells us anything, it's that we are going to see more of the latter there, Josh, it sounds like. Thank you so much for joining us and sticking around. We really appreciate it. Our very own Josh Schaefer. Now, Boeing announcing it will buy Spirit AeroSystems in a $4.7 billion deal. That's in an effort to improve quality and safety, according to the company. Now, this comes as U.S. prosecutors are reportedly seeking a guilty plea from Boeing over allegedly misleading a federal regulator about the 737 MAX planes that were involved in those two fatal crashes, according to several reports. For more on this, we're joined by Mike Boyd, Boyd Group International President. We're also joined by Andy Pastor, former aerospace reporter for the Wall Street Journal. Thank you both so much for joining us this morning. Mike, I want to start with you to just get some context here for our viewers. What do we know about this agreement from Boeing to buy the fuselage maker Spirit AeroSystems here? And what do we know about the potential impact that could have on Boeing in the stock price?
Well, I think it's a diversion. Number one, Boeing's having a hard enough time handling their own production. Buying back Spirit isn't a guarantee of nothing other than Boeing will be managing it. There has to be more than that. Again, you know, to charge Boeing with criminal malfeasance by the government is sort of like a fire alarm company suing a building for having had a fire. We're in a situation here where Spirit is Spirit, and there's no guarantee that Boeing will be able to manage it any better than they can manage their own operations.
Andy, I want to get your read in on the situation. I mean, especially as we're and have been tracking Spirit AeroSystems with direct correlation to this acquisition and what we were anticipating from Boeing and Airbus as well, which also announced that they were purchasing the division of Spirit, at least that has a little bit more manufacturing for its own aircraft.
So I think the important thing to keep in mind is First of all, this is a reversion to some policies that Boeing had many years ago, where all of this work would have been kept in-house. So they basically reversed course in that way. But I'd like to talk a little bit about this potential criminal plea agreement. It's really a slap on the wrist for Boeing. It's a minuscule fine of about $250 million, which of course is almost a pittance for a company that has spent billions and billions trying to make changes and recoup from the two crashes. And it's important also to understand that the families and the victims of the families of the victims and their lawyers have been demanding much harsher action from the Justice Department, larger fines, criminal proceedings against individual Boeing executives. The reason that isn't happening, and this hasn't been talked about very much, the reason that isn't happening is because in the chaotic days of the end of the Trump administration, the agreement that Boeing signed with the Justice Department in 2021 essentially poisoned the well for any strong, forceful action by the Justice Department in a very clear break from Justice Department practices over the years. The Justice Department said it found no evidence specifically that senior executives were involved in any of the potential fraud related to the MAX design. The Justice Department almost never does that. They simply don't charge individuals. They don't explicitly say that there's no evidence against anyone because someone walks in with a box of documents the day after, of course, the whole question becomes much different. So I think that this is a slap on the wrist. It's almost a symbolic punishment. Boeing has been immune to such symbolic punishments over the years. But the reason I think that the Justice Department isn't being more forceful has a lot to do with the fact that they were locked into a certain legal position by the Trump administration years ago in 2021, and they simply can't go back and essentially relitigate and try to create a new criminal case from those facts.
So, Andy, really quickly, what does a potential Trump reelection mean for Boeing's future?
I don't think it has any effect at all. This agreement, if it comes to pass, will be a done deal in a matter of days or maybe a week or two. It'll have to be approved by a judge. The families of the victims will complain vociferously, but by the middle of the summer, late in the summer, this will be a moot point. The Trump administration won't be able to legally intervene and try to change any of these issues. The Trump administration, if there is one, will be able to make major decisions about regulating the company, about overseeing its production, about what happens on the production line and so on. But in terms of this legal settlement relating to the previous crashes, I don't think that the Trump administration will be involved whatsoever.
Mike, what do you need to see from Boeing in order to believe that there's been a significant cultural shift internally at the company?
Well, I think after this deal comes down, probably Calhoun will see the front door. He should have been kicked out the door before. I mean, he is responsible for this. Hopefully, we will see a new improvement at the FAA. They're responsible for the oversight, and they failed before the MAX. Now they failed since the MAX. But I think the big thing is there'll be a symbolic, basically kicking him through the goalposts of Boeing and getting rid of Calhoun. Who they replace him with, I don't know. But Boeing can't sit any longer like this, acting like they're doing things when they're not. Going forward, I think Boeing will have to have a totally different management, and I do think this legal activity will probably force the rubber stamp board to do something.
I want to stay with you here, Mike. Obviously, there's been a lot of discussion about any potential new CEO to come in at Boeing. Is there a name that you have not heard discussed that you think potentially has a chance of getting that seat or would be open to it, given so much volatility that executive would be inheriting?
It's a very tight, what they should hire is somebody who's very tight, who knows some engineering, knows some of it, but also knows how to rebuild a company. I mean, the problem with Boeing is they inherited people from McDonnell Douglas who didn't know anything. They inherited a whole bunch of people from GE, which were really good at tearing companies down rather than building them. So I think it's going to be a very hard thing to find somebody. I think there's someone out there. I don't have a name, but it has to be somebody who wants to go in there and not be a rubber stamp and does understand that Boeing needs a whole new product line. In 5 years, they're going to be in a world of hurt because they haven't invested. That's what we really need.
Mike, Andy, great to see you. Thanks so much for joining us this morning. Mike Boyd, Boyd Group International President, and Andy Pastor, who is the former aerospace reporter for the Wall Street Journal. Great to see you.
Thank you.
Thanks. We're just getting started here on the Morning Brief. Coming up, NVIDIA getting a price target hike from Morgan Stanley. We've got some top trending tickers next. Plus, France's far right leading the first round of elections. What this means for the markets internationally later on in the show. We've got all this and much more. You're watching Yahoo Finance Morning Brief. Morgan Stanley hiking its price target on NVIDIA to $144 from $116 and reaffirming their overweight rating, saying it has the most compelling narrative in the AI and semiconductor space here. There you're taking a look at the rating, the price target, and the logo on screen. They say they're not pounding the table at these levels, given the sharp appreciation since the last earnings report, but as they transition ultimately from H100 to H200 and then Blackwell, visibility and backlog will improve materially, they expect, writing in this note.
Yeah, it's interesting because I've been speaking with some analysts about the Blackwell chip for another piece that I'm working on, and there's not transparency from NVIDIA about the cost of each individual chip on each generation, but the estimate for a Blackwell chip is in the neighborhood of $35,000 to over $50,000 per individual chip, and each customer is going to be buying a heck of a lot more than one of those chips, and it's all profit margins for NVIDIA. They're looking at over 75% on the margins here for that product. So when you think about the fundamentals like that, it's difficult to have an argument against this stock. Having said that, I watched a powerful TikTok this weekend that reminded me to always look at the risk for every stock story. So I thought I needed to work that into my own coverage here at Yahoo Finance. The risks here, right, that the AI chip purchasing could be cyclical, that this could be a one-time thing, and that all these companies investing in AI could decide, actually, we don't really know what to do with this, so we're going to taper down our investments and just stick with the chips we already have, see how they work, and then come back to this narrative later. That could hinder NVIDIA's growth moving forward. Also, big potential risk here is the geopolitical volatility that we're seeing in the South China Sea. If we do see any type of invasion of Taiwan, that is where TSMC is located. That is the manufacturer of all of these chips. That would be a huge headwind, not just for NVIDIA, but for all of the chip makers in the space, and could be a huge headwind for the chip makers if that geopolitical risk, which is very difficult, obviously, to price in, did come to fruition. So those are some risks to come despite this call on NVIDIA here. Now, shares of Chinese EV makers are on the move this morning. We've got NIO, XPeng, and Li Auto moving to the upside after the companies reported better than expected delivery numbers. The trio delivered about 196,000 vehicles in the second quarter. That is up about 47% year over year and up from the 132,000 cars delivered in the first quarter of the year. You can see all those names here moving to the upside. But Brad, it's interesting when you talk about these deliveries because we're also going to be getting Tesla deliveries here tomorrow. And I've been getting a lot of notes in from analysts saying that the next 6 weeks to come are a huge potential catalyst for Tesla stock. You've got their earnings coming out in a month here, which is crazy. We just wrapped up earnings. We're already rearing back in.
Yeah.
And we've got those delivery numbers here as well. And then, of course, you've got consistent commentary from Elon Musk, which tends to move the stock. So a lot of movement in the EV space. And then you have the tariffs in the background here coming from not only the U.S., but also Europe, the impact that that could have on these Chinese EV makers, obviously not having that big of an impact here on the day, given this news about the delivery numbers, Brad.
Yeah, and for the names that are on the screen right now, and NIO, XPeng, and Li Auto, of course, this is a read into the all-important Asia-Pacific market where Tesla is trying to grow its own positioning, and so it'll be easy or interesting to see where the numbers overall come in for Tesla. Of course, if we get any breakout on Cybertruck, we probably won't, but hopefully we start to at this juncture because of the way that it's been broken out before, where you get the 3 and the Y, which are really the lion's share of production and deliveries, plus then the S and the X, which are, you know, at this point trimming, continuing to move lower. But then once you kind of factor in the Cybertruck and the deliveries, I've seen just a wave of ugly Cybertrucks on the road, whether that be in the decals that people are putting on them or just in the clunkiness of them on the roads. But all these things considered, it'll be interesting to see if they do break out Cybertruck officially, since recalls are really the only way that we know how many they've been able to put into the market. That aside, NIO has had a stinker of a year. When you look at the stock price, it's down by about 50% year to date. So yeah, a pop here this morning, but ultimately there's still a lot of road to be proven for each of these companies that you're looking at on the screen.
Don't buy Brad a robo-taxi. That's my takeaway. No gift of a
I
robo-taxi.
would ride in a robo-taxi.
You're like, if
not
it's a
first,
gift,
but I would ride in it at least once. We'll see. Let's also talk about La France. French markets, they're ticking higher here. This after the far right winning the first round of the country's snap elections, but failing to secure an absolute majority, which eased investors' concerns about an outright victory. To discuss, we've got Yahoo Finance's very own Kiko Fujita. Mon ami, all you.
Good morning to you, Brad. Yeah, the CAC 40 index is pushing higher, but it's paring back its gains after jumping nearly 3% in the first minutes of trade. That initial investor relief, that far-right leader Marine Le Pen's national rally failed to gain an outright majority in this first round, now turning to caution with that second round of these parliamentary elections coming up this coming Sunday. President Emmanuel Macron called snap elections last month, saying France needed, in his words, a moment of political clarification after far-right candidates made huge gains across Europe in European parliamentary elections. That turned out to be a huge miscalculation. Take a look at the results coming through. The far right took 33.1% of the initial vote. The left-wing New Popular Front captured roughly 28%, leaving Macron's centrist alliance with just 20.7%. Voter concerns in France are going to sound very familiar to Americans here. Immigration and inflation, the high cost of living, really key concerns here. The National Rally putting a staunchly anti-immigrant message front and center, and that really resonated with the voters there. This morning, both leftist and centrist parties are scrambling to prevent the far-right party from gaining an outright majority in the National Assembly. The parties have until Tuesday to pull candidates off the ballot to try and consolidate some of those votes. For investors, there are serious concerns that a government led by the far right or the left would lead to more spending in the way of fiscal policy, adding to a growing budget deficit. There's also concerns about the long-term future of the euro. Now, we have seen the euro edge slightly higher, although it is still weaker than where it was before those snap elections were called. The best case scenario for markets, according to most analysts right now, a hung parliament that would not necessarily lead to significant policy accomplishments, but pretty much this status quo. But of course, we've still got another round to go, and we'll be talking about that next Sunday, guys.
All right, Akiko, thank you so much, as always, for joining us on that. We really appreciate it. It's very interesting given what we're seeing in this election. We're going to talk a little bit later in our show about the likelihood of Macron dropping out in order to consolidate those votes here. And as Akiko was mentioning, we did see some movement in the CAC overnight to the upside. Le Pen not doing as well as anticipated, but cooling off a little bit this morning as we head into the bell here in the States.
Just seconds away from the opening bell. You still do have pretty much an action-packed week, even though it's holiday abbreviated. Fed Chair Jerome Powell going to be speaking in Portugal. Fed President of New York, John Williams, also in Portugal. So a little Euro trip for both of them here. There you're taking a look at the NYSE and the NASDAQ. We've got bells, folks. All right. Toga ringing the opening bell at the NYSE, ticker symbol TOGA, Toga. And then you've also got Breakthrough T1D, looks like. They're over at the NASDAQ. Great group of folks that you see opening the bell in Midtown Manhattan. All right, that does it. We're underway here as we start the third quarter of 2024, the second half of 2024, I might add as well. Taking a look at the Dow, the S&P 500, and the NASDAQ, you're seeing gains across the board to begin things. All right, happy face on that one. Dow is up by about 0.25%. You're also seeing the S&P 500 up by about 0.2%, and the NASDAQ composite starting off on a positive note. It's up by about 0.2% as well.
It is, and it's interesting given that I want to pour some cold water on the optimism here. Fewer than half of the major markets rose as the share of stocks trading above their 200-day moving average fell in the month of June. So definitely some question marks remaining here about the consolidation that we are seeing. Let's get to it with Yahoo Finance's very own Jared Blickery on what is moving markets so far after that opening bell about a minute ago. Jared, what do you have for us?
Yes, we have a bullish start to the new quarter, and this is as expected. I've been running seasonality numbers over the last couple of weeks. We've been sharing them. I'm writing about it in tomorrow's morning, in tomorrow's morning brief. Excuse me. In fact, we've been up 9 of the last 10 weeks in stocks. So let me just show you what Ryan Dietrich has prepared for us. This is his own seasonality studies, but a lot of these are basically saying the same thing. S&P 500 up double digits at the midpoint of the year. Full year has never been lower, and it's up 25.1% on average. Rest of the year up average of 7.7%. Nearly 83% of the time are they positive. So this just goes to show you that what we're seeing right now probably going to continue, but not necessarily throughout the entire period. I do see some weakness potentially in August, September, and October. But let's get back to the markets now. I did want to check on the sector action. Excuse me. Tech was an early leader, but it is in the red right now. Utilities is leading the pack. And I got to check in on crypto. Excuse me, guys. Bitcoin is up 2.3%, and we can see, there you go, just about at the flat line.
All right, Jared, thank you so much for joining us. We really appreciate it. And interesting, again, to see not only the movements in Bitcoin, but some of the broader market action that we are seeing as we kick off the start of this year. As I said, we are just kicking off the first trading day of the second half of this year. We're going to be speaking with a strategist on what you can expect for the rest of the year after this break. But for now, we are looking at gains, as Jared was mentioning, across your screen. The S&P actually coming back off of its highs of the day from the pre-market here, but still up about 0.3%. The tech-heavy NASDAQ up about 0.25%. Stick with us. Markets are edging higher to kick off the second half of the year. That is after an AI-fueled rally in the first half, driving 2/3 of market gains. To discuss what we might see for the second half of this year, we've got Jeffrey Kleintop. He's Charles Schwab's Chief Global Investment Strategist and Managing Director. Jeffrey, thanks so much for being here. Look, I feel like we've had this question mark about consolidation and valuations for quite some time now. At what point do you see that question mark becoming a real risk to this market rally?
You know, we've been fans of AI and AI stocks for quite a while now, but we're tempering that enthusiasm, actually looking to leadership from sectors like financials and energy and materials in the second half of the year. You know, a very unique thing happened in the second quarter that's only happened 5 times in the last 30 years, and that's the indexes were up on average, but the average stock was down. For the S&P 500, the index was up 4.3% in Q2, but the average stock in the S&P 500 was down 2.8%. And that was true around the world. We could even see it in the all-country world index from MSCI. That was down. The average stock was down 1.7% in Q2, even though the overall benchmark itself was up 2.4%. And you're right, it's all about AI. And so that increasing concentration of performance in Q2 is something we have not seen in a long time. So yes, AI's outperformed for a while, but it's the only thing seemingly outperforming in Q2. And I think the risks to the market in Q3 tied to that very narrow leadership suggest that investors should look for some diversification out of those handful of stocks.
When can investors know that it's the right time to begin taking profits in their AI trade?
Well, when they can see that there are opportunities elsewhere, there are a number of other parts of the market that are much more attractively valued and have increasing earnings momentum. You know, one of the things that we've seen over the last 4 or 5 quarters is that AI stocks have driven almost all the earnings gains. In fact, the average stock has seen earnings losses in the last 4 quarters on a year-over-year growth basis. That changes now. We're actually starting to see here in the third quarter earnings, even outside the U.S., the earnings for the Euro 600 index or the Euro Stock 600 index are expected to grow faster than those in the S&P 500 this quarter. So you're finally starting to see earnings growth that exceeds that of the U.S., exceeds that of the tech sector outside of that. And I think that's the turning point here in terms of relative performance.
Jeffrey, I also want to talk to you about what we're seeing in terms of global elections, obviously following the news of Marine Le Pen's success overnight in France. But also we are seeing this global push towards more of a populist policy regime. To what extent could that reverse some of the inflation progress that global central banks have made, given some of the policies that do come with populism?
It's a great point when we talk about widespread tariffs, and it's not just the U.S. that's talking about increasing tariffs. Europe has talked about that. Japan, many countries, Canada are focusing on that. So when we have multiple barriers to trade and increasing tariffs around the world, well, that certainly does risk higher inflation. Also a slowdown in the increasing momentum in manufacturing. You know, manufacturing was in recession last year. We've finally seen a recovery there. That's helped lift economies like Germany's out of recession. But the concern is that export growth then begins to weaken for manufactured firms. So the recovery we've seen and the decline in inflation is at risk from populist policies. We'll have to see how much they actually take root should these populists win. France will be an interesting referendum on that. Of course, we've had elections in India and Mexico where we did see populists win and stocks sold off 6% when they reopened. It'll be very interesting to see what happens on Sunday. And then, of course, on July 4th in the UK, when we've got maybe the election going the other way towards the Labour Party.
You know, Jeffrey, as we think about the back half of this year, I mean, it really does come back to what the pathway of inflation looks like, where employment situation holds up in the Fed's dual mandate here. All that considered, it's really just trying to price in when we see some interest rate cuts. For the Fed, you know, how are you looking through their calculus and what they've been signaling thus far?
We all year have been penciling in about 2 rate cuts from the Fed. So we were way behind when the market was thinking there was going to be 6. And now we're thinking that, you know, we're a bit ahead of the game as the market's pondering whether there'll be any at all. I still think we're going to see the moderation in inflation necessary to get the Fed to those 1 or 2 rate cuts later this year. That should begin to weaken the dollar, which is something that should help international investors or U.S.-based investors investing internationally finally see some of those gains translated back into dollars. Japan's stock market's up like 18% this year, but in dollars only about 6%. So getting that stabilization in the currency could be really important in the second half.
Jeffrey Kleintop, Charles Schwab, Chief Global Investment Strategist and Managing Director. Jeffrey, always a pleasure to grab some time with you.
Thanks for having me.
Thanks. We've got all your markets action ahead. Stay tuned. You're watching Morning Brief.
Oil prices are moving higher this morning. You can see on your screen here, WTI crude and Brent both moving to the upside. Now, this comes amid a resurgence of geopolitical risks globally and increased demand driven by summer driving. Joining us to discuss his call on the price of oil is Andy Lippo, Lippo Oil Associates President. Andy, thank you so much for being here this morning. Talk to me about your call for the price of oil and what you think will get us there by the end of this year.
Well, good morning, and thank you for having me. I think the biggest fear in the market is the geopolitical tensions that we're seeing in the Middle East, especially as Israel is reducing its fighting over in the Gaza area, moving troops to the northern border with Lebanon in anticipation of more violence with Hezbollah, which ultimately could bring Iran directly into the conflict. And that's the oil market's concern, because that could spread to interrupting supplies throughout the Persian Gulf region. So between that, as well as increasing demand from now through the end of the year, I'm expecting to see Brent crude oil prices drift up to about $90 a barrel.
Andy, you know, one of my kind of sub things to watch for the rest of this year, which, you know, I had to put on the back burner and save for this conversation, fortunately, was what OPEC may do on the supply side towards the end of this year. What are you anticipating the actions could be for how they might actually spur or put even more supply into the system, and what that would mean more broadly?
Well, in early June, OPEC Plus surprised the market in the sense that not only did they extend their production cuts through the end of September, but they did decide to start reducing those production cuts beginning in October. And those voluntary production cuts, of course, were led by Saudi Arabia and Russia. It's easy to see that OPEC Plus has surprised the market before. They could do it once again. If crude oil prices were to remain in the $80 per barrel range, they could extend those voluntary production cuts through the end of the year. But the initial announcement from OPEC Plus was reacted quite bearishly with the oil market as they saw more supply coming onto the market sooner than expected.
Andy, how does the presidential election play into your outlook here? Because there are many who have come on our show to argue that the president will do whatever he can to keep the price of oil down heading into November 5th.
Well, the Biden administration has certainly taken a number of steps to do that, whether it's releasing strategic petroleum reserve crude oil last year or this year recently releasing gasoline in the strategic petroleum reserve in the Northeast. I think post the election, it's difficult for either administration to control the world oil market. The best they can do is through our foreign policy of exporting additional quantities of energy allows us to have more of an influence in those markets. But one can see with the geopolitical tensions in the Middle East, the United States' influence is really limited.
Well, I want to end by going global with you here, Andy. I know that there is a lot of risk globally here. You've got Ukrainian drone attacks on Russian refineries. You've also got the potential growth story in China. You also have the tensions in the Middle East. Which of those seems to be the biggest geopolitical risk in terms of the potential impact on crude moving forward here?
I certainly think that it's in the Mideast. What we've seen from Russia and Ukraine is that over time, Russia has been able to skirt the sanctions. And in addition, the China growth story, continues to dampen enthusiasm in the oil market. We just saw that China PMI was down to 49.5 last month, which is the lowest it had been in the last 5 months. So, of course, that is always dampening the enthusiasm on oil prices.
Andy Lipow, who is the Lipow Oil Associates President. Andy, thanks so much for taking the time here this morning.
Thanks for having me.
Certainly. Everyone, we've got much more coming up on the Morning Brief. Stay tuned. Democrats facing what could be a brewing crisis here. The political party is torn over whether President Biden can take on former President Donald Trump in November. The first debate of the 2024 election cycle kicked off last week. Biden's performance left voters increasingly concerned around his age, raising questions as to whether or not he should drop out of the presidential race and how Democrats might replace him. For more on what this could mean for markets, we've got Brian Gardner, who is the Stifel Chief Washington Policy Strategist. Brian, great to have you here with us. Okay, so just the likelihood that we would see any replacement at this juncture, especially considering how much they were continuing to push out some of the campaign and rally and Waffle House videos over the weekend.
Yeah, so it's less than 50-50 that the president would drop off the ticket. But it clearly is not zero. I have it around 40%. Clearly going through the weekend, there was pushback from the inner circle, from the Biden family. So the tea leaves right now suggest that he's not going to drop off. At the same time, anybody who watched Thursday night knows that there are challenges for the president going forward and for the party more broadly. So you can't dismiss the idea that there will be an effort to persuade him to drop off. The idea that he would be pushed out is very, very low, almost zero, but that he could be persuaded to step aside. It's not zero, but it doesn't look like we're heading in that direction.
Do you think that he should, Brian?
It's tough for me to say, without sounding partisan. But look, I think people can look at the debate the other night, especially people who have situations with friends and family who are older, in their older years, and you see how age progresses. And so the question is not just can the president go up against Donald Trump in the upcoming campaign, how effectively can he serve and be president in another term? That's a very serious question right now. I think to an objective observer who watched Thursday night, the answer is probably no. And so it's not for me to say because I'm not part of the Biden family, but they need to have a very serious conversation right now.
I also want to get your take, Brian, on a new CBS News poll showing that an increasing number of voters do not think Biden should be running after that debate. Over 70% of them saying, to your point, that he does not have the cognitive health to be the next president of the United States. That is up from 65% previously there. Given that polling, I am curious from your perspective, if Biden were to drop out of this race, how does that impact who could potentially get into the White House next year, right? It looks like increasingly voters are not thrilled with the idea of Biden being in the White House. Does that necessarily mean that they would be thrilled with whoever else goes up against Trump?
That's a great question, and it probably gets you back to the answer of why he probably stays in, because the selection process for Democrats to pick a replacement could be disruptive, chaotic, fracture the party. You start with his vice president, who has her own political weaknesses, does not poll particularly well. If you go beyond her to other Democrats around the country who may not have a strong base or a national base of support, this is a very complicated process if President Biden were to step aside. And so, I think there are probably people within upper echelons of the Democratic Party who may not be happy with how things went on Thursday night, but they also know the alternative isn't all that great. So, yeah, there would be a conversation of the vice president, of Gavin Newsom, of Gretchen Whitmer, a host of other Democrats. Getting from where we are now to replacing Biden is not an easy task.
How has the questions and commentary from your peers at Stifel, from your clients, evolved since post-debate? I imagine the types of questions you were getting right after the debate. How has that conversation changed through to today?
I think they reflect what's been going on in the broader population. Just a lot of surprise, to a degree of shock at the performance on Thursday night. I think there's a reflection that the odds of a Trump victory have gone up. We were kind of evolving slowly in that direction over several months, with investors becoming more confident, believing that Trump was more likely to win. That jumped up after Thursday night. But I think those conversations generally are one, what sectors do well, how does the market react, but also just the general sense that reflects everything you've heard about, what you guys have been talking about on your shows, and what you've read in the media. Is there a leading candidate you believe could replace Biden? I think you have to start with the vice president. She would have a big but not insurmountable advantage. She would inherit the Biden campaign, the Biden fundraising apparatus. I think the president himself would probably lean into her candidacy a little bit for two reasons. One, to validate his selection of her back in 2020. And two, he's been a vice president. I think he's very sympathetic to what Kamala Harris goes through every day. It's not easy being vice president. You have the president's staff kind of carping at you all the time. So I think you start there. After that, then I think it's an very open field.
All right, Brian, we're going to have to leave it there. Thank you so much for joining us this morning. That was Brian Gardner. He is Stifel's Chief Washington Policy Strategist. Now, coming up, we're going to have some breaking manufacturing data from the ISM at the top of the 10 a.m. hour. We're going to dive into those fresh numbers on Catalysts next. 10 a.m. here in New York City. I'm Madison Mills alongside Brad Smith this morning. Thanks for joining me at the top of the hour here. We're going to dive into the catalysts that are moving markets today.
We're kicking off a new month, quarter, and half with a fresh read on the economy. ISM manufacturing data breaking right now. We'll dive into the latest data in just a second.
And markets in the first half were led higher by the AI trade. We're going to discuss the catalyst to watch in the second half of the year.
Plus, uncertainty in Europe. France's far-right party led the first round of parliamentary elections. We'll discuss what it means and why it matters for investors globally.
That's right, but first we're going to get to the breaking news we have here, which is manufacturing data from ISM coming in at 48.5 versus the 49.1 that investors were anticipating. The ISM manufacturing prices paid the lowest of the year here, coming in lower than previously. The previous low came in March of this year. Actually, the previous high, rather, came in March of this year. So seeing continued weakness here. Also taking a look at some of the data that could play into some of the jobs data we get later this week. We saw employment falling to 49.3 versus 51.1. Now, we did see new orders rising to 49.3 versus 45.4. So seeing a little bit of a mixed picture when you look at that. Prices paid also fell to 52.1 versus 57. That is the lowest reading since December. So seeing perhaps a little bit of cooling there. Really interesting, though, Brad, to see that employment number falling to 49.3 versus 51.1. Obviously, that's not a huge amount of coolness, but that could be enough to fuel some of the data that we're expecting later this week when we get that key jobs report.
Yeah, net, this is a continuation of the contraction that we've seen. You got a comment here from Timothy Fiore, who is the chair of the Institute for Supply Management, ISM, and essentially saying U.S. manufacturing activity continued in contraction at the close of the second quarter. Demand was weak again. Output declined. Inputs stayed accommodative. Now, demand slowing was reflected by a few things, one of them being new orders index improving to marginal contraction, new export orders index returning to contraction, and then the backlog of orders, he also notes, dropping into stronger contraction territory. So all this considered, output that remained in decline. Actually, it declined compared to May, I should say. Combined 3.5% point downward impact on the manufacturing PMI calculation here.
Yeah, and it looks like we're seeing gains across the major indices, including the NASDAQ flipping back into positive territory after getting pushed to the downside a little bit earlier. Those stocks coming here after we got that ISM data. Now, the big question, could markets be prone to a correction in the coming months after the record-breaking gains that we saw in the first half of this year? Joining us to discuss exactly that, we've got Irene Tunkel, BCA Research Chief U.S. Equity Strategist, with us here at the Stools. Irene, thanks so much for coming in this morning.
My pleasure. Thank you for having me.
Yeah, of course. So we just got this data in coming in a little bit cooler than anticipated, seeing some positive reaction, a little bit of action in the yield space here. But as Brad was mentioning, this is perhaps what was sort of anticipated. This is part of the narrative we've been seeing. What do you make of the data?
Well, I think that for now, it appears that the bad news appears to be good news. Mm-hmm. And the reason for that, the Fed put is alive. So the market is thinking, well, you know, economic growth is slowing, but it's slowing gently. And so it creates conditions for the Fed to cut interest rates. And no one is at the moment expecting a hard landing. I'm probably not in that camp, but if you think about what investors, or majority of investors think, they think it's a gentle slowdown and then rates will go down and, you know, the party can continue.
When are you anticipating that first cut? And hopefully, yes, we all want the party to continue, but when do you anticipate that first cut?
Well, it's, I would think that the end of the year is most likely, simply because of the political uncertainty. I don't think that the Fed would like to lose this perception of its independence. But I think that what is important is whether the Fed is reactive or proactive. If by the time that the Fed cuts rates, economic data deteriorates to the point that it's very hard to deny that the US economy is going into recession and the Fed is responding by cutting rates, I do not think it will help equity markets, simply because it will indicate that, well, we're already in a recession. Nothing can help, help equities at this point. However, if they cut rates and the economy is still strong, perhaps slowing gently, but it's still strong, but they manage to cut rates preemptively, I think that will prolong the strong performance of the market.
Does it matter as much what the Federal Reserve does? Obviously it matters, but given the concentration of this rally being really driven by AI, driving 2/3 of the market rally so far this year, if people keep buying chips, does it matter what the Fed does?
I think to a degree. I would argue that it may not matter, when the Fed exactly cuts interest rates, but it matters what they say. And what is the perception of the market about the trajectory of interest rates? And we're talking about the first rate cut, but perhaps we need to think about the longer sort of time frame for rate cuts. And I think it will matter, and that's why everyone is listening to every single member of the Federal Open Market Committee so intently. In terms of the concentration of the market, this rally is a little bit longer than it is, and I would argue that the AI trade is kind of in a bubble. The difficult part of it, and there is always a caveat, bubbles can last for a while and they're very hard to time. And so this party could continue again just simply because there's still lots of money chasing these amazing AI stocks. But to my mind, what I see in the market, I would say that this rally is getting a little bit tired. If you look at equal weighted S&P 500, it hasn't really budged since March. And so you cannot really count on just a few stocks to carry the market much further. I think it's time to take profits.
If it is indeed a bubble then, and some people are going to start to take profits to try and get ahead of that bubble bursting, what type of rotation do you think we might see? And also a reset of valuations too?
Yes, the market is kind of richly valued. And again, you can say that, well, there is a bifurcation because there is the Magnificent Five or Six or whatever you basically qualify, and everyone else. But I think that even if you strip off the Magnificent Five, the rest of the market is not as expensive, but they're not going to deliver so much growth either. And so you really need the top stocks to perform and to justify the market, but they have gone up so much. And it can be just profit taking, just like we've seen a technical correction with NVIDIA. Nothing really happened, but sometimes you just have to put profits on your books.
Well, and this morning, NVIDIA is down a little bit off of an upgrade. I mean, it's just, the start of the second half of the year, maybe some worries about concentration. Having said that, where do you see the biggest opportunity for investors who do want to get in on AI, but don't want to invest in companies that are perhaps overvalued?
Well, I think that, every new technology cycle goes from infrastructure and, this overused word, term picks and shovels, and then you move to applications, and then you move to the real companies that are trying to adopt these new technologies for their businesses. And I think that what we are focused a lot now is on companies that can use this generative AI to cut costs, to improve their supply chains. And even Apple is a case in point. What they're doing is kind of going to make devices incrementally better. But it's evolutionary change. I think where we need to look for the impact of AI, and it may take long, it may be more expensive, is revolutionary. And that will be in healthcare, it will be in aerospace and defense, it can be in fintech. So I think that the next phase of this transition, of the generative AI transition, is to look where can we actually see this new technology completely changing, the playing field and the rules of the game.
How concerned are you about those exact companies doing a one-time investment into AI and then stopping that CapEx or capping it?
You mean the companies that are developing this revolutionary sort of changes?
The companies utilizing the AI, like a healthcare company, for example.
Yeah, I think that they will be investing in AI just to maintain, but I think it really will be, a big shift forward to build out the infrastructure. And actually, it may be a little bit different than we expect because AI models are getting smaller and smaller and much more customized. So maybe you can use, less powerful chips. Maybe you can spend a little bit less on them. But I think that on the long-term effect will be much more pronounced than what we see with the Magnificent Five because we're just talking about chatbot, but there is so much more to generative AI than chatbots.
All right, we're going to have to leave it there. Thank you so much, Irene.
Thank you.
Really appreciate you joining us.
Loved it here.
Irene Tunkel, thank you so much. VCA Research's Chief U.S. Equity Strategist joining us in studio. Now coming up, Birkenstock getting an upgrade from UBS. We got some top trending tickers along with Birkenstock after the break. Meta stock is under pressure this morning, down over 2%, around 2% in the pre-market after the market open here. The company accused by EU regulators of failing to comply with landmark antitrust rules over its recently introduced ad-supported social networking service. Yahoo Finance's Dan Howley has the details for us. Dan.
That's right, Maddie. This is a preliminary finding, so it doesn't necessarily mean anything is going to happen to Meta at this point. But essentially what the European Commission is saying is that Meta is in violation of the Digital Markets Act, which is basically that massive law in the EU that is supposed to kind of put the reins on some of these big tech companies, whether that's Apple, Microsoft, or in this case, Meta. Now, what the European Commission, is saying is that Meta is violating the DMA by not abiding by a particular guideline. And in reality, what they're saying is that Meta is offering two different versions of its products, Facebook and Instagram, with two different rules that users have to follow. Either you can get Facebook or Instagram for free and allow Meta to hoover up your data. That's the kind of ad-free, the ad version, or you can get an ad-free version, but you have to pay for it. Now, the European Commission says that's not the same product. Essentially, they're saying everybody has to offer a similar product if users don't want to have their data hoovered up. In this case, Meta says, well, look, we're offering a similar product, you just have to pay for it. And the European Commission says, no, that's completely different. Users shouldn't have to pay for it. They're also talking about users having their right to freely consent to having their data used. And so this is a big deal for Meta because they thought that they were going to be abiding by the new DMA rulings. Clearly, the EC doesn't believe that, and so they could be on the hook for up to 10% of their global revenue. Now, that would be billions of dollars in fines they have to pay, more so if the European Commission finds that they're repeat offenders. And it's not just Meta that the European Commission is going after. They're also going after Microsoft, saying that they package their Teams software and gives them an unfair advantage, and Apple over its App Store practices. And so, this is just another example of the European Commission kind of bringing the hammer down on these big tech companies. And it's similar to what's happening in the U.S. to a degree with antitrust, but obviously the European Commission making faster moves and more moves.
All right, Dan, thank you so much for joining us. We really appreciate it. Moving over to France, Marine Le Pen's far-right party wins the first round of France's legislative elections. The National Rally Party clinching over 33% of votes, with President Emmanuel Macron's party just above 20%. That's according to data from the French Interior Ministry. French markets initially rallying on the results before pulling back a bit. So what does this mean for the broader market, both in Europe and globally moving forward? Joining us to discuss, we've got Gurpreet Grewal, Goldman Sachs Asset Management fixed income strategist, joining me now. Gurpreet, thank you so much for being here with us. I want to talk about where we go from here first. There's this question about whether or not Macron could move to the sidelines here to consolidate the votes against the far-right party. To what extent do you anticipate that happening?
Hi, first of all, thank you for having me on. And look, big picture from a fixed income perspective, we're focused on three things. First and foremost, it's really the direction of travel for fiscal policy, and clarity of that is not going to come until the second round of the election. And one thing to look, at least in the immediate term, is to see how a French government bond auction goes this week to gauge investor appetite. After that, the focus is really on medium-term budget plans and fiscal proposals submitted this autumn. The second key thing that we're really focused on and monitoring is any potential contagion to other markets. So far, that's been relatively limited. French issuers are a small part of the US investment grade market, for example, relative to the European investment grade market. So that's helped limit contagion. The ECB also has tools at its disposal, like the transmission protection instrument, that it could activate to address any unwarranted sovereign bond volatility. And the third key thing that we're focused on is really, does all of this pose any potential implications for the European Central Bank and its path to policy normalization?
Well, talk to me about that, because there's this idea that we have started to see cooling inflation globally, that central banks have been doing the job when it comes to inflation, but populist policies do tend to be inflationary. To what extent is that a risk that the ECB needs to start really being concerned about?
Look, it's a great question. First of all, let's take stock of what you've seen happen in European inflation dynamics recently. The trends have actually been encouraging. You've seen that a lot of the start of the year price and wage adjustments may be behind us. Goods prices are in check, rents are in check, inflation expectations are anchored. But there are risks, like you mentioned. On one hand, if you have tightening in financial conditions related to political uncertainty, that could actually necessitate a more dovish policy stance. But on the other hand, even though investors may have become cautious on French assets, consumers are still actually very constructive on Europe as a tourism destination, so relatively constructive on its beaches, and that could present upside risks to the inflation outlook, at least in the near term, through core services inflation and tourism-related categories like hotels, airfares, and so forth. And so these complex dynamics really underscore the fact that the ECB is going to maintain its data-dependent approach.
Well, when you mention data dependent, I do, of course, think of our Federal Reserve here in the United States. They love that phrase more than anything. It's interesting because on Friday, we saw this kind of bear steepening in the U.S. in the Treasury space, and it's potentially indicative of action that could have been related to economic data we got from the UMich data on Friday. To what extent do you see the fixed income market in the United States continuing to be that data dependent moving forward and really moving off of every single piece of economic data that we're getting? And what does that tell you about how investors should be positioning around treasuries?
Yeah, look, I think investors are focused on all of the data because the Fed has emphasized to us that their policy is going to be determined by the totality of data. And so it's really about forming that mosaic on the macro data front. What do things look like based on the latest inflation readings? What's happening on the jobs? April and May inflation data moved in an encouraging direction. All eyes are on the jobs report this week. We're looking to see if the labor market is continuing to rebalance in a way that would alleviate wage pressures and therefore services inflation pressures, and therefore open the door to rate cuts. In terms of how investors should be positioned, we're actually cautiously constructive entering the second half of the year. Why are we constructive? Well, like I mentioned, disinflation progress is back on trend. Labor markets are still healthy. That supports consumer spending, a key determinant of growth in almost every advanced economy. Private sector balance sheets also look relatively healthy. Favorable market dynamics means that companies have been able to refinance if they want to. So why are we somewhat cautious? Well, because valuations are tight or extended. You see this with tight corporate bond spreads. And as you noticed at the outset, we have political uncertainty. And so against that backdrop, we still like to position for attractive income in securitized credit, corporate bonds, and then also have some macro rates exposures to play divergence that you're seeing in central bank policies.
All right, Gurpreet, we're going to have to leave it there, but really appreciate you joining us. Thank you so much. That was Gurpreet Garawal, Goldman Sachs Asset Management Fixed Income Strategist. Now, Birkenstock shares are rising after UBS upgraded the stock to buy from neutral. You can see the stock is up over 2.25 percentage points here, hiking its price target on the stock to $85 from $52. The firm saying the company is successfully executing its expansion strategy. Yahoo Finance's Jared Blick joins us to discuss. And Jared, I was just taking a look here at what's going on with the stock. It looks like Hedgeye Risk Management also just raised the recommendation on Birkenstock from sell up to hold. So interesting to see this amount of analyst movement on this stock. Why are we seeing all of this?
Yeah, and it comes over a month after their last earnings report, so sometimes it takes a while for price action to get people interested and say, well, maybe there was something in that report that we like. So I think investors are focusing on a couple things here. UBS in particular is noting their direct-to-consumer building out effort. That has been going well. And he's also noting that there are a couple overhangs that have been lifted or are in the process of being lifted. One is that last year they got that incredible Barbie bump, and this year they are lapping that. So can they keep up that incredible growth? Well, that can be tough to do on a short-term basis. And then also the other thing is that they're saying guidance leaves little room for further upside. In other words, that the company has really met a lot of the guidance that they've expected and pronounced for themselves. So you put it all together, this price target, I believe it's a street high now, $85. Citi separately is reinstating a buy with with a price target set to $65. And I should note, too, there was a share sale by corporate insiders last week. The reports are that it was for tax purposes. It doesn't seem to have mattered. Sometimes people think insiders are selling, but not always the case there. So if we go to the Wi-Fi Interactive, I thought we would chart this real quickly. And today you can see we are up 2.4%. But let me put a max chart on, because this stock came to market less than a year ago or abouts, and you can see it's been a steady trend upwards. I just note that because Birkenstock is a new company coming to market, and a lot of these new issues in the IPO market have not done so well. But this is a company that's, at least price performance-wise, has been able to capitalize on some of that earnings momentum.
And it's an example of one of the companies that is clearly not an AI play at all, right?
I'm trying to think. No AI embedded there, I hope.
No sourcing from you about an AI chips play when it comes to Birkenstock. So it does paint this idea that we hear a lot from guests into context that stock picking is becoming increasingly important given the concentration of this rally.
Real quick, if we could go back to the Wi-Fi Interactive, I'm going to sort this, the apparel heat map by performance year to date, and you're going to see what a bifurcated market it is. You got winners and losers, and so congratulations if you're in the winners camp. Birkenstock is.
And wow, look at ANF up over 100% year to date. Abercrombie and Fitch continuing to succeed there. Jared, thank you so much, as always. Really appreciate your insights here. Now, coming up, the 2024 presidential election cycle just getting started, at least kicking off following that debate here. We're going to dive into the policy themes that you need to watch next on Catalysts. The 2024 election could be a key risk for markets in the second half of this year. Just this summer, we got a packed schedule. Trump's sentencing in his New York hush money trial on July 11th, the Republican vice presidential selection coming up on July 15th, and we've got the second presidential debate set for September 10th. So how should investors be preparing for all of these key events? Joining us to discuss, we've got Lisa Thomas, TD Cowen's Deputy Head of Research. Lisa, thanks so much for being here. I know in your list of mid-cap ideas here, you have a section zeroing in on Washington policy for 2024. I'm curious, from the perspective of you and your colleagues, which candidate could potentially fuel more gains in this mid-cap space, given the potential policies that they could be putting in following November 5th?
That's a great question. But you know, what I will say, Madison, is what we have been really focusing on are the names and on the themes that are really going to endure regardless of which party and which candidate takes the White House and takes Congress. Because as you point to, there are a lot of catalysts between now and the election. There's going to be a tremendous amount of noise in this cycle. I get to use my favorite expression, which is this one goes to 11 on a scale of 1 to 10. So I would say, in fact, we're really, really focused on investments and on themes that are going to have that long cycle durability to withstand, the whipsaw, regardless of who is in place. Because on those themes, we think, in fact, there is a tremendous amount of bipartisan agreement. If you're talking about things like U.S.-China decoupling, if you're looking at U.S. protectionism and industrial policy, and by the way, deficit spending, because despite the rhetoric that you might hear on both sides, what we think is that you are very unlikely to see lightening on defense spending at a time when we are seeing such geopolitical risk on so many fronts. So rather than really focusing on which party is going to, be, I think, the best driver for mid-cap stocks, we would argue there are a lot of great mid-cap opportunities, regardless of who's in the White House.
So what is the thinking that investors should try to adopt heading into this busy cycle in order to not get spooked by the noise, as you call it?
Yes. Look, again, I think it's really focusing on those long-run themes. So if you're looking at industrial policy, certainly AI is, on everyone's mind and on everyone's lips. And we're looking more and more at those second and third derivatives of AI use cases. But in the meantime, we're putting tremendous focus on AI infrastructure. What are all of those, architectural enhancements and improvements that are needed to really fuel the AI use cases that everyone's looking to? So, for example, we upgraded Credo Technology, which is a mid-cap name in the space that is working on enhancing speed in the data center. They had previously had a lot of customer concentration between Microsoft and Amazon, but that's broadened out a lot. And we think that investors are increasingly starting to embrace those kinds of infrastructural names. DigitalBridge is another name that supports hyperscaler data center operators with a portfolio of companies in that digital infrastructure space. We think increasingly by looking at names that are really tied to those long-run themes, then you get to steer clear of the noise. You get to see what happens, just as we all are, because certainly, particularly coming out of last week's debate, the endless headlines, the endless noise. We don't think that you're going to win in investing by getting caught up there. Focus on what's going to matter regardless of who's in the White House, regardless of who's in Congress, and what's going to matter with some real durability over the next several years.
And I know that big names like NVIDIA have obviously really ruled this AI surge. What smaller names should investors be taking a look at if they do want to play AI, but in the smaller and mid-cap space?
Yeah, again, we think that some of those names like Credo, which we just upgraded, or DigitalBridge are great ways to play the data center. And we just had our entire technology team out with, I think it was a 400+ page report out of TD Cowen on, the data center and all of the elements of data center investment that people should be focused on, because, whether it is looking to the power constraints that are going to be driven by this huge surge in data center reliance, or whether it's in the speed enablers and the data center architecture enablers, such as Credo, or whether it's in looking at a broader portfolio of names around digital infrastructure, where you have an opportunity to be levered to a number of really high quality names through an investment in DigitalBridge. We think those are really, really good opportunities. They still have a lot of upside. As you point to, large cap stocks have really outperformed. And of course, it's been really a very small number of stocks within the large cap space, the Magnificent Seven, and even a smaller concentration within that has outperformed. So we think the timing of this piece is great because investors really are taking a step back, looking at SMIDs, which are undervalued, or certainly seeing a near historic valuation gap versus large caps. And they're really asking whether this is an opportunity to broaden out their portfolios and potentially broaden out the rally so that more folks in the market and more stocks in the market are participating in it.
All right, we're going to have to leave it there, Lisa. Thank you so much for joining us. That was Lisa Thomas, TD Cowen's Deputy Head of Research. Still to come, President Biden considers his political future. How is Wall Street reacting to the latest from the presidential race? We'll cover that and more next. This is Catalysts.
From creating graphics cards for gaming to becoming one of the world's leading AI chip companies, it's safe to say NVIDIA is officially one of the tech giants. In 2023, the company generated nearly $27 billion in revenue, and its market cap is currently hovering at around $3 trillion. Let's take a closer look at what led to NVIDIA's boom with Beyond the Ticker, where we dive into the company's biggest moments. NVIDIA was founded on April 5th, 1993 by Jensen Huang, Chris Malachowski, and Curtis Priam, with a vision to bring 3D graphics to the gaming industry. In 1997, NVIDIA launched its first hit product, the NV3. It would later go on to sell a whopping 1 million units in its first 4 months of availability. On January 22, 1999, NVIDIA went public via IPO at $12 per share. And in 2000, Microsoft chose NVIDIA to develop the graphics hardware for the first Xbox console. 5 years later, Microsoft's rival Sony chose NVIDIA's hardware to power the PlayStation 3. In 2010, NVIDIA became the graphics chip supplier for automaker Audi. And in 2015, the company launched its NVIDIA Drive chip for powering driver assistance technologies. In 2016, NVIDIA kicked off its AI efforts with the launch of the DGX-1. 2 years later, the company debuted NVIDIA RTX, the first GPU capable of real-time ray tracing. That same year, Google announced it was using NVIDIA's Tesla P4 graphics cards for its Google Cloud platform. In 2022, NVIDIA debuted its H100 graphics chip for AI, which still stands as one of the world's most powerful chips for artificial intelligence apps. On June 5th, 2024, NVIDIA eclipsed that $3 trillion mark, joining the ranks of mega companies Apple and Microsoft. The stock continues to surpass its all-time highs over the past month and is currently trading well over $1,000 per share. From a company of 3 engineers working on graphics cards to thousands of employees working on chips that will power the AI supercomputers of the future, NVIDIA remains at the top of the tech industry.
We have breaking news. The Supreme Court ruling that former President Donald Trump has some immunity from criminal charges related to his attempts to reverse the 2020 election results. This partial backing of the former president would delay any trial related to the matter. Joining us with more, we've got Yahoo Finance's Rick Newman. Rick, thanks so much for coming in on this breaking news. What do we know?
Well, we're still sorting this out. It's somewhat complicated, as many of these opinions are. But the Supreme Court has said that the president does have absolute immunity from prosecution for official acts he conducts as president, but he has no immunity for unofficial acts. And the court is sending this case back to the trial court where this all began. And part of what they will have to do at that trial court is determine what is an official act and what is an unofficial act. And just to remind everybody, this whole prosecution, this is one of the 3 federal prosecutions, two federal prosecutions of Donald Trump. This is the one in Washington, D.C. that is meant to determine whether he has culpability for the January 6, 2021 riots at the U.S. Capitol. So I think what this means in terms of the election timing for this year is this is not going to get to the point where we get to a hearing actually determining whether Trump is guilty or not guilty, but that we are going to have hearings based on trying to figure out which of these allegations constitute official acts, which Trump would be immune from prosecution for, and which might be unofficial acts that Trump can be prosecuted for. So Trump is not off the hook here by any means. This is going back to the district court, and it looks as if some point there will be a trial, but probably not before November.
Yeah, I'm interested, Rick, in the difference between the wording here. The court ruling there is presidential immunity for official acts, not unofficial ones, as you mentioned. Just explain to me, like a layperson, what exactly that means and what that could mean for Donald Trump.
Well, I mean, this all gets into splitting hairs on definitional issues. And I think part of what the court is saying here is we have not exactly decided what constitutes an unofficial act. So I think you can think of it in these terms. It's an official act if it has something to do with the functioning of the government or the president's job as the nation's chief executive. Now, to put this back in the context of the time, this was all about the 2020 election, and running for election is not, to my mind, an official act. That is an unofficial act. That is not something the president is doing in his role as the guy who's running the government. He's doing that to try to get reelected to a second term. So that's not running the government. That's a political activity which to my mind is not an official act. But that is just my interpretation as a layperson. I think, and this all is going to have to be in the context of the actual charges. So the court is going to have to go to the actual charges and go through them and figure out, well, if this charge relates to what is clearly an official act, then we're going to dismiss this charge, get rid of this one. So it's going to winnow the case down, I think, to what the prosecution can most plausibly claim were not official acts by Trump acting as president of the United States, but unofficial acts by Trump acting as a candidate for elected office.
All right, Rick, we're going to have to leave it there. Thanks so much for joining us on this breaking news. We appreciate it. We're going to stick with the court's decision here. The Supreme Court ruling former President Trump does have some immunity from criminal charges related to those attempts to reverse the 2020 election results. Here with more, we've got Scott Bessent, Key Square Group LP founder and CEO, as well as the former CIO of Soros Fund Management. He is also a Trump supporter. Thank you so much for being here with us. Just talk to me really quickly about your initial reaction to this news.
Yeah, look, I try to stay mostly in my finance lane, and I think we see that the Democrats' lawfare strategy hasn't been a great strategy thus far. If it were an investment strategy, I think it would have been pulled, because every time President Trump's been indicted, his popularity goes up. Since the verdict on May 30th through June 15th, there was a record amount of fundraising. I think the Trump campaign raised $400 million.
How does this impact fundraising, do you think, from institutional investors, from Wall Street, from CEOs?
Yeah, look, I think this probably doesn't have much of an effect. I think we can get on with the election, and we can see who's the best candidate.
Well, let's talk about the election and the policies at play here. One of the big policies from former President Trump, of course, is tariffs. The consensus view from some of the biggest banks on Wall Street is that the policies Trump is backing would be bad for the economy, would be inflationary at a minimum. How do you justify tariffs as an investor yourself?
Well, look, I think that they were wrong in Trump 1.0. I think they'll be wrong in Trump 2.0. If we go back to tariffs, who liked tariffs? The original Treasury Secretary, Alexander Hamilton. Why did he like them? For two reasons. One, it brought revenue into the new country, the United States of America. Two, he was of the opinion that it would protect nascent industries. And I think we heard from President Trump on the debate on Thursday night and in other conversations, he thinks, three, that tariffs give him negotiating leverage. So look, I think, my inclination is when we hear 60% tariffs on China, that's the beginning of a maximalist negotiating position. That's the way President Trump negotiates. I would be surprised if we ever hit that. But I think, given his record in Trump 1.0, he has a lot of credibility in using tariffs to negotiate.
I want to bring up a quote from Mike Wilson from Morgan Stanley. He said, risks are skewed to the downside for growth under Republican win scenarios, due in part to immigration reform and tariffs. And this echoes concerns more broadly that Trump's immigration policies would be inflationary because they would raise labor costs. I mean, this is a real concern from some of the biggest banks on Wall Street. What is your take on that?
Yeah, I know Mike well. I think he was wrong on this. I think that a Trump 2.0, or let's go back to the whole arc of the news cycle. We began 6 or 9 months ago with Bidenomics are great, and Bidenomics, that dog didn't hunt. The American people didn't like Bidenomics. Then the news cycle coming out of Delaware. And kind of put forward by Paul Krugman, Greg Ip, Alan Blinder, was, well, it's just really a vibe session. The American people don't understand how really good they have it. This inflation wasn't that bad. Even I thought it was a tone-deaf remark by Secretary Yellen last week when she said that she hadn't personally seen inflation at the grocery store. Mm-hmm. But that the vibe session failed. So now we're in part 3, and part 3 is conjuring a monster that somehow Trump 2.0, to define all logic, is going to be inflationary or, unbelievably, as Larry Summers says, stagflationary. Trump 1.0, we had the non-inflationary growth, some of the strongest growth we've had in 50 years. And I think we're going to have the same thing again, because, if you counterbalance, first of all, with the tariffs, traditionally, I'm a markets guy and an economic historian. Traditionally, you get a 50%, whatever the level of the tariff is, you get a 50% appreciation of that amount in the currency. So it's a 10% tariff, we get a 5% currency appreciation, which takes care of some of the inflationary effects. We didn't see inflationary effects with the tariffs on China. We'll see with the labor, but I personally do not have a problem with the bottom 25% of American workers getting higher wages and the benefits they deserve. They have been crushed by this unfettered immigration. But let's go back to why Trump 1.0 was disinflationary. Regulations were cut. We had energy dominance, and the energy prices were low. And I think under those scenarios, it's almost impossible. Could they offset each other? Sure.
Scott, just to jump in, I did want to zero in on the immigration piece specifically, because there is a real concern that curbing immigration would lead to an increase in labor costs, which could fuel some of the inflation that the Federal Reserve has been fighting against. And we currently have 8 million open jobs. So the argument that curbing immigration would hinder job openings, I struggle to see that.
Well, think of it this way. I think the 8 million job openings are not the people who are pouring across the border every day. They're not going into jobs at Microsoft and senior management. So I think that's not right. With the deregulation, what's really caused a lot of the Biden inflation is you've got a demand shock from this out of control government spending, 7% deficits, and then you have a supply constraint from all the regulation. So what we didn't talk about was, I believe that a Trump 2.0 is going to get these budget deficits under control, and that the theory of the price level says that once the budget deficits go down, inflation will come down.
Well, we've been talking about inflation. I'm curious, I know you're under consideration for Treasury Secretary if President Trump were to get into the White House again. Would you argue for firing Jerome Powell in that position?
Look, I think President Trump understands that what anchors inflation expectations is the credibility of the Federal Reserve. I think Jerome Powell has done an extremely poor job, but I don't think it's to anybody's advantage to fire him. I think that his term will run out. I think that he will be replaced. And I think President Trump, just like President Biden, President Biden, even in the State of the Union, called for lower rates from the Fed. So I think, President Trump's going to make his opinion known, but, I would not advocate for replacing Jerome Powell before the end of his term.
At the end of his term, then, who would you want to take that position?
I think that there's a very good list of both market participants, academics, former Fed officials.
I also want to talk to you a little bit more about the fundraising piece. The former president has not publicly gotten support from a single Fortune 100 CEO. That's according to several studies here. I'm curious, do you know of any Fortune 100 CEOs who are supporting President Trump privately?
Well, look, I actually think that that's a positive because, under the Biden administration, big companies have done great. And, they're rent seeking. They want to be adjacent to the government. And, I would also say that, the Fortune 100 CEOs, what they may or may not think in private, They are terrified of their shareholders. They're terrified of their board of directors. So I put that study came from Yale SOM. It was highly partisan. I think that we are seeing private individuals. I think we are seeing private companies. So the fact that a CEO doesn't make his or her fundraising known, I think it just speaks to kind of the rent seeking that we're seeing in the Biden administration. When you give out a lot of government goodies, you want to be on the receiving end.
All right, Scott, we're going to have to leave it there, but we really appreciate you coming on to discuss this. Thank you so much. That was Scott Bessent. He's Key Square Group LP's founder and CEO. We're going to have all of your markets action ahead right here on Yahoo Finance. Stay tuned. You're watching Catalysts. We were just speaking with Scott Bessent. He is allegedly one of the frontrunners for Treasury Secretary if Trump gets reelected. Yahoo Finance's Rick Newman is standing by with us. Rick, thanks so much for being here. You just heard that interview. I'm curious, what are some of your takeaways that viewers should keep in mind?
I would just provide some context and a little bit of fact checking here. I'm just going to run through these really quickly, Maddie. First, at the beginning, he justified Trump's idea for more tariffs on imports by saying, well, Alexander Hamilton, who was the first Treasury Secretary, he was a big fan of tariffs. And he gave two reasons that Hamilton loved tariffs. Number one, they brought revenue into a new country. On that, I would point out we're not a new country anymore. And we, at the time, we did not have any kind of income tax. We now have an income tax and a corporate income tax, which Hamilton did not have back in the 1700s. And he said Hamilton also liked tariffs because they protect nascent industries, except we're not talking about nascent industries. We're talking about established industries. And look, we are thoroughly integrated with other economies through trade. So just to keep that in mind, I thought this was a useful insight. He said when Trump talks about a 60% tariff, a new tariff on all Chinese imports, he said, think of that as a maximalist position that might be for leverage in negotiations. So in other words, maybe Trump would settle for something far less than 60%. Well worth keeping in mind. Just real quickly, he said Janet Yellen said she went to the grocery store and saw no inflation. That is not true at all. Actually, Janet Yellen said on Yahoo Finance last week, she goes to the grocery store and she sees lots of inflation. He said during Trump 1.0, which is a phrase he used a lot, we had the strongest growth in 50 years. We had pretty good economic growth under Trump's first term. It wasn't the strongest in 50 years. I think for that, you could go to Bill Clinton in the 1990s. He complained about out of control government spending under Biden. Maybe, although of the 4 COVID stimulus bills, Trump signed 3 of them, and that accounted for about 2/3 of that spending. You asked him about tariffs being inflationary, which they are. They add a tax to the price. He said, well, yeah, but at the same time, they strengthen your currency. So that offsets some of the inflation. I would say, well, 2 things to that. Why do it if you have to if you're hoping for something to offset it, number one, and number 2, when your currency gets stronger, exports go down. That's terrible for exporters. So you have to explain that to exporters. And I thought he kind of hit the right tone on Jerome Powell. Trump always talks about firing the Fed chair, but he said he thinks he's done a poor job, but don't try to fire him. Just let him finish out his term, which I think expires in 2026. So just some context on that very interesting interview, Maddie.
Rick, thank you so much for giving us that context and for all of your help with that interview. We really do appreciate you, as always. That was our very own Rick Newman. Coming up right here on Yahoo Finance, we've got Wealth, dedicated to all of your personal finance needs. Our very own Brad Smith has you right here for the next hour, so stay tuned for more.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, we're entering the second half of 2024 and the first day of the third quarter. We have an investment playbook for you straight ahead. We'll talk about the themes that will matter to you for the remainder of the year. And good news for student loan borrowers. A key part of President Biden's repayment plan will resume after a judge granted the administration's request to stay an order that blocked a provision of his plan just last week. Plus, the cost of your home. We'll talk about the cities with the largest and smallest rent increases in the month of June. And an expert's going to give you tips on how to get the most affordable apartment. All that and much more coming up during today's show. But first, let's take a look to the markets here. Stocks right now are mixed to start a new month, quarter, and second half of the year. The S&P 500 entering Q3 up 14.5% so far this year, while the tech-heavy NASDAQ composite rallied more than 18% thus far coming into the start of the second half. Markets in the first half largely led higher by the AI trade. More than 2/3 of the S&P 500's gains for the year have come from names like NVIDIA, Alphabet, Apple, and Microsoft. Investors want to know whether or not the AI trade, of course, is still hot on the back half of 2024 here. And for an investor's guide to the second half of the year, we're joined by Dana D'Auria, who is the Envestnet Co-Chief Investment Officer. Great to have you here in studio with us.
Thank you so much.
Absolutely.
Thanks for having me.
So, first, let's start there with the AI trade that has absolutely fueled so much new vigor into a theme that investors who were perhaps a little bit more passive are now becoming a little bit more active about here. How much more legs do we think the AI trade has at this juncture?
Oh, I think the AI trade has plenty to go, right? We're sort of at the beginning of this. If AI takes off in any way, in any of the ways that we expect in terms of increasing productivity, enabling companies to change the way they do business, we're going to have a huge, huge demand for AI. So we're just at the start of this. I think what's going on, of course, is that there's a lot of focus around NVIDIA. And so where goes NVIDIA, folks think goes the AI trade, which is not necessarily the case, right? This thing has to broaden out much more.
Where would that broadening kind of start to take effect from your purview?
Yeah, so I mean, to start with, I think you're still looking at companies that support AI in terms of needs semiconductors, for example, right? Equipment manufacturing that's necessary for AI. Energy, of course, has been a huge theme this year around AI and the expectation that we're going to need massive amounts of energy to power this. So if you think about some of the international spaces where some of this stuff is made, and they're maybe not priced so stratospherically as what you're seeing, in cases here in the U.S., that's one way to play it. I would say to be very careful, though, about AI washing, right? And this notion that, I'm an AI server, I'm an AI this or AI that, right? I mean, putting the words AI in your earnings script is a good thing, so everyone's doing it.
Yeah, FactSet's been tracking the number of mentions, and it seems quarter after quarter that they're saying, hey, once again, this is a new record quarter for the amount of mentions of AI on earnings calls. All of these things considered here, one of the other major themes or catalysts, if you will, that investors were tracking coming into the start of this year, and they're going to continue to track going into the back half, is the policy pathway for rate cuts. What is your best estimation of when that will start to, or if it's impacting people's playbook?
Yeah, it's definitely impacting the playbook, I think, for sure. So much in terms of our economy is interest rate sensitive and starts with, what's going on with interest rates. I think small caps have had a lot of pain, for example. They're known to be more interest rate sensitive, and that's hurt them the higher for longer. So I do think, that monitoring of exactly how many cuts, I think, look, everybody kind of thinks we're going to get some start on the rate cuts this year. It would be an odd play to get moving too early on rate cuts, considering where our economy is. I mean, GDP is, it's good. It's not the blowout it had been for a while there, but it's good. Unemployment's fantastic still, right? I mean, there's really not cracks there. So with the market doing very well, GDP kind of remaining pretty good, and unemployment low, employment strong, it's really hard to make a case that we need rate cuts right away. That being said, in a re-election year, the Fed usually cuts rates. So we should expect some. So is it one, is it two? Betting odds probably one before the election, one after the election, but there's a lot of data to come in between now and then.
Is there a good election rule of thumb that investors need to remember as they're trying to really navigate what could be some potential volatility, as UBS had put it in some of their election watch coming into that general election?
Yeah, look, I mean, the empirical evidence, looking historically at what happens in election years, there hasn't been a lot by way of correlation between the party in power and whether markets in general do well. Although much attempt to, create something like that, right, and find that kind of a link. But that being said, of course, this election in particular, there are clear winners and losers that the market, in fact, you have whole country economies, markets kind of moving on the basis of this election. So, China versus India, right? Trump wins, not good for China, maybe not good for Mexico, good for India, and vice versa. So the idea of this nearshoring and Trump kind of coming in and with much more massive tariffs. So I think when you're looking within countries and within sectors, yes, there are clear winners. Financials got a big bump after the debate. I think we can all, kind of point to why that was the case. So, as you're looking at the second half and you're judging where you're going to be in terms of the market, the other thing I would just remember is, look, the market prices this information pretty quickly into the prices. And I think a lot of times people forget that. Yeah. So the price has to reflect both the potential outcomes and the probability all in one number. So it's going to move at least to a certain extent to what the expectation is. And then when the actual the event happens, the rest of that movement tends to happen. So getting ahead of that is a very difficult thing to do.
Dana, great to have you here in studio with us. Thanks so much for kicking off the second half of 2024 with us. Appreciate it. Dana D'Auria, who is the Envestnet Co-Chief Investment Officer. Great to see you.
Thank you.
The Biden administration's new student loan repayment plan getting the green lights to resume over the weekend. A federal appeals court granting the saving on a valuable education, or the SAVE plan, stay is what it was given after a provision of the plan was blocked after a judge issued injunction last week. Now, this gives the administration the go-ahead to lower borrowers' monthly payments. This impacts around 8 million borrowers who have signed up for the new income-driven repayment plan so far. Now, the plan eliminates 100% of remaining interest on subsidized and unsubsidized loans after making a full scheduled payment. Now, increases the income exception, which cuts monthly payments. So this also excludes the spouse's income if filing taxes separately. So what does all this mean? Well, it's a major win for President Biden. The administration has forgiven about $167 billion in student loan debt during the presidency, according to the White House. Well, before we all head out for July 4th later this week, we will be getting some brand new jobs numbers that could actually give us a better picture on the state of the economy. For more, we bring in our own Josh Lipton, who's been tracking all things employment situation. Hey, Josh.
Brad, good to see you. So you're right. It's a holiday shortened trading week here, but we still do have some important economic data to consider. Remember, last week we got the University of Michigan's Consumer Sentiment Index. The final reading was 68.2 in June. Strategist Peter Boockvar notes that was down from May and the lowest since November, but better than the initial June print, so Boockvar says positive, though still weak. Turning to this week now, we're going to get a window into the labor market with ADP on Wednesday. U.S. private employers are expected to have hired 158,000 workers last month. Of course, that report is published ahead of the Labor Department's more closely monitored employment report coming out on Friday morning, the all-important monthly non-farm payrolls data for June. Now, economists expect the report to show that 190,000 non-farm payroll jobs were added last month per Bloomberg, with unemployment holding steady at 4%. Remember that in May, the U.S. economy added 272,000 jobs. Added up, and economists see a labor market that is cooled but isn't cold, in their words. So the question now, what comes next? As Nick Timros of the Wall Street Journal puts it, is the labor market in a sustainable equilibrium where unemployment settles at around 4%, or, he asks, keeps softening, resulting in recession, as historically has occurred when unemployment rises much more than it already has. Economists, of course, have different takes. A more optimistic view comes from Ed Yardeni, who tells clients that he is not concerned about our labor market, emphasizing that private payroll employment is driven by corporate profits. And as he points out in this chart, the S&P 500 forward earnings continues to rise to record highs. Bottom line, Dr. Ed says, profitable companies tend to expand their payrolls. But a cooling labor market, coupled with signs that inflation is moving in the right direction, have implications for the Federal Reserve, of course. Markets currently assigning a nearly 62% probability of a rate cut in September. Would a cooler jobs report on Friday morning give our central bankers greater confidence to make that move? Investors are going to be watching. Brad, back to you.
All right, thanks so much. Excellent breakdown. Some key data that we're going to be tracking even during this holiday abbreviated trading week. Josh, thanks so much.
You got it.
Well, how much do you have saved for retirement? Depending on your age, you may be a bit more stressed about that balance. We break down all the tips and tricks to make sure that you have enough to live out your golden years. That's right after the break. Stick with us. 55-year-olds have a median retirement savings of less than $50,000, according to a Prudential report. For a demographic just a decade away from retirement, that's pretty far from the target of having 8 times your annual income saved. To break down how to catch up and how younger generations can start off strong, we've got Yahoo Finance's own Kerry Hannon here to discuss. Kerry, what do we know about how people can close that gap between what's necessary and where things currently sit?
Absolutely, Brad. Great to be here. Yeah, this study is a little alarming because that short runway to retirement for someone who's 55. And it's worth noting because this generation also in the report showed that they're woefully short when it comes to emergency funds. They just seem to be grappling with a lot of financial issues. Inflation certainly plays a role in that. But what's concerning is that sort of, and if you recall, Gen X is the 55-year-old is square in that age range, from around 44 to 59 this year. But here's the good news, Brad. It appears that younger generations are actually getting started investing earlier, and this bodes very well for their retirement. Another report I saw from Schwab actually showed that whereas Gen X didn't get started saving for retirement, so that 55-year-old, until age 31, the Gen Z, so our youngest generation, those who are in their early 20s up to, say, age 27, they started at age 18. Millennials around age 24. So we're seeing some momentum there of getting going a bit earlier with the younger generation. The message is getting through. And the other thing I noticed in some of the new reports is that in the percentage of people who are actively investing, I was really curious. It was really curious for me to see that Gen Z, again, those younger folks just getting rolling in the job market, are investing at a rate of around 45%. And that is really encouraging. So that was one thing. The other side of the equation is Fidelity's first quarter report came out. And they actually pointed to some numbers that were a bit optimistic and good for that Gen X, that 55-year-old. They said that Gen X has a total savings rate, the ones that they monitor in their retirement plans, of over 15%. And that's above what they recommend as a good rate of savings. That's a combination of personal savings into your retirement account and your employer contribution. But the good news here, again, Gen Z, hey, they're going for it. They've got 11% total savings rate right now. And I'd say that was pretty good. I don't think I did when I was that age.
Yeah, no, me neither, Carrie. So what action can people take right now to better position themselves?
Yeah, Brad, that's really important to focus. Let's go back to that 55-year-old that has under $55,000 saved for retirement. You have absolutely got to make saving a priority. You do have some runway, but the fact is, someone who thinks they're going to retire at 65, people really often retire at 62 for a whole gob of reasons. It could be physical reasons or what have you, layoffs. But so they may only have 7 years, not 10 years. So buckle down, really rev it up. And one expert I talked to said, hey, if you can save 25%, go for it, of your income towards your retirement savings. So that would be really cool. The second thing you really absolutely need to do is, if possible, push back taking your Social Security. This is a hugely unpopular suggestion. Most people really like to jump right into Social Security as soon as they can get it at age 62. But the fact is, if you can wait till age 70, and I know that's a big ask, but if someone has the ability to do that, you get the biggest paycheck moving forward for the rest of your life. There's an 8% increase each year from your full retirement age, which is around 67, to age 70. So if you can possibly do that, and in order to push it back, that third tip is try to stay on the job as long as you can. Obviously, if there's physical issues, health issues, you can't. But the longer you can keep working, keep your skills up to date, stay in the job market, you can push back taking that Social Security and really improve your retirement security in the future. So those are really things that I think people need to focus and buckle down.
All right, some top tips. Carrie Hannon, thank you so much breaking this down and the results of the survey, plus some actionable items that people can really capitalize on. Thanks so much, Carrie.
Thanks so much, Brad.
You got it. Well, our interest rates right now, interest rates are high. But for how long? The majority of interest rate traders are pricing in a rate cut in September, so it might be time to re-examine your portfolio to look at investment areas that are rate sensitive. A big one, CDs. This is a type of savings account that pays a fixed interest rate for an agreed period of time. So, is now a good time or not a bad time to get into CDs, or is the answer more complicated than this? And certainly, let's get a full breakdown on this. Right now, we've got Corinne Balterson, who is the head of wealth at Curinos. Great to have you here with us, Corinne. First and foremost, as people are trying to figure out why CDs make sense right now, and also trying to kind of examine what the Fed's policy pathway may look like, what is the top thing that they should keep in mind with this type of instrument?
Absolutely. Thanks for having me this morning, Brad. In the wealth space, CDs are definitely a much different option than what you see in the traditional retail space. For wealth clients who have so many different options for where to place their cash, it really is a balancing act around how much of a return are they looking to get? How much money do they want to have in a consistent, steady rate versus in the market where there can be some volatility? What we've seen for the first time in recent history is that wealth clients are adopting retail CDs. And what's happening there at the start of 2023, CDs represented just 3% of wealth deposits. And clients were adopting CDs, about 10% of acquisition balances going into retail CDs. That picked up greatly last year. As you could get to a 5% handle on a CD, there's something in the mentality of an investor that 5% seems great. And so even wealth clients started adopting CDs at a much higher pace. It's been about 20% of acquisition dollars going into CDs since mid-23. That's not slowing down at all as long as we stay in this higher for longer environment. And CDs now represent about 11% of wealth deposits.
So, Corinne, what happens when the Fed begins its rate cutting and the pacing of that still remains unclear, but what happens when that pathway really kicks off?
So, Brad, what's really been interesting, I think we need to look at what's happened since last July. Historically, in times between when the Fed stopped raising rates and started lowering rates, that's when the market outperformance led more investors into the market versus keeping that money in cash. We haven't really seen that this year. People are holding more money in cash than ever before. So as rates start to go down, I think there's going to be a real shift once clients can no longer get that 5% handle anymore. And then there's going to be another sort of mental break there at 4%. If rates rest at, the 3.5% mark that everyone's sort of betting on, it is highly unlikely that wealth clients in particular will continue to adopt CDs. They can just get a higher yield in the market. Right now, they have options with money funds and treasuries where they don't have to lock up their money for so long to get that 5% handle.
And so what is a way that someone could get involved or could exercise an opportunity to make sure that they're taking advantage of the full benefits that a CD might give them? Where does that thought process even initiate for a lot of people?
Absolutely. If I could predict the market and where rates are going, I certainly wouldn't be sitting in this seat, I'll tell you. But for clients who are interested in locking in, we do believe we're at top of market right now. And so that 5% and the impending rate cuts, whether it be September, later this year, or the multiple rate cuts that are going to be happening next year, this could be the last opportunity to get in at that 5%, lock it in, and have that. What we see with wealth clients is that they are much less likely to lock in for a longer term. So in the retail space, clients might be betting right now and locking in for 12 months. A wealth client would rather kind of preserve that optionality and have liquidity to be able to go into the market. And so most wealth clients are locking their money up for a maximum of 9 months, with the majority at kind of 6 to 7 months right now. We saw for the first time in history that clients were timing their CD maturities in the wealth space with tax time. So they would have their renewal go into a checking account and then use those funds to pay taxes. Whereas in the past, it was money moving from the market into checking in order to pay taxes.
Corinne Baltzerson, who is the head of wealth at Curinos. Corinne, thanks so much for taking the time here with us today.
Thank you.
Certainly. Coming up, everyone, as former New York City mayoral candidate Jimmy McMillan once said, the rent is too damn high, and it just keeps getting higher in some areas. We'll discuss why next. Mortgage rates have come down recently, still remaining near that 7% level, but easing in the last few weeks. But for many homeowners, they could soon see their monthly payments rising. Yahoo Finance reporter Danny Romero is here with why. Why are you doing this to them, Danny?
Brad, a shockwave may be coming for many homeowners. Data from Intercontinental Exchange shows that more than 100,000 loans will reset in the next 12 months. Now, these are homeowners that have an ARM loan, an adjustable rate mortgage loan, which can offer temporary relief for homeowners who want to avoid paying higher mortgage rates. But they also come with a risk. Homeowners have a fixed period, usually between 5, 7, or 10 years. Then the rate on an ARM loan adjusts based on market conditions. Now, due to rates staying high, many ARM loan holders are experiencing an unpleasant shock of higher monthly housing payments. About 1.7 million homeowners have bought homes with an adjustable rate mortgage since 2019, and that's according to data from Intercontinental Exchange. Now, remember, an adjustable loan can make sense for home buyers comfortable taking risks of interest rate increases, or those who plan to move and refinance before that fixed rate expires. Now, it's also very key to pay close attention to those details of your loans. Otherwise, things can really turn ugly. Brad?
Yeah, Danny, let's talk about rentals here. A new report says that the average apartment sizes are getting bigger. How much bigger and why?
Bigger living spaces are making a comeback. The average size of a new apartment has increased by 27 square feet from the previous year. Now, that's the size of a kitchenette or a small bathroom. Now, the reason behind a bigger new apartment space is that there's more supply of 2 to 3 bedroom apartments that have been added to the market. Now, it's cities like Jacksonville, Florida, Orlando, Florida. They are the cities that are offering larger new apartment spaces. But even here, Brad, in New York City, new apartments are getting roomier by 16 square feet, which could be a small walk-in closet, Brad.
Wow. Okay. All right. Kudos to all the people with the shoe collections out there getting a walk-in closet. Danny, thanks so much. Well, let's stay on the topic of rents. Asking rents for apartments in some of the biggest cities in the U.S. have risen by double-digit percentage points since June of 2023. Here with more information on where rents are rising and where they are falling, we've got Crystal Chen, who is the Zumper spokesperson. Crystal, great to have you here with us. So where are the hot spots where rents, let's start with the good news, where they're falling?
So we have a report that we publish every month, and our most affordable cities right now are Wichita, Akron, and Shreveport. And our most expensive cities are in New York City, New Jersey, and in San Francisco. We're seeing a ton of supply coming onto the market in the Sun Belt. So markets in Florida, Texas, Georgia, they're seeing double-digit rental price declines versus the Northeast and Midwest markets like New York City, Chicago are seeing rents up in the double digits annually.
I'm glad that you mentioned that because construction is obviously everywhere in New York City where we are, but I wonder in other parts of the country that are seeing perhaps stronger construction, the net effect that is having on rents and what the kind of trend is that renters are expecting in this near term.
So yeah, I think nationally our index shows that rents are up 1 to 2% year over year, which is pretty low. But if you dive into regions, you'll see that, like I mentioned, if you're living in the Sun Belt area, you'll see all this new construction and you'll see rents decline a bunch annually versus in New York City, rents are the highest of the nation, and the current vacancy rate for New York City is 1.4%, which is down from the 4.5% rate that it was only 2 years ago. So even though there is a lot of construction in New York City, there is still so much demand, and that demand has even spilled over into neighboring states like Connecticut and Jersey, since New Haven and Newark rents are also up about 7% annually too.
Yeah, that's been remarkable to see, especially with those who are accessing public transit just to commute in, commute out of the city. While we got you, we got to give people some actionable tips to really help find an affordable apartment. What are some of the mechanisms that they can deploy to make sure that they're getting a good deal?
Yeah, so the first one would be use seasonality to your advantage. Winter is the best season to move, since typically property owners tend to price down units to fill vacancies before the holidays. And there's typically the lowest competition and demand overall. So if you're looking for a good deal and you can move in the winter, that would be the best time to snag a deal. Also look for move-in specials. As I mentioned, there's a ton of inventory hitting the US market this year, I think peaking at a 50-year high this summer. So a lot of new buildings are offering concessions like 2 to 3 months of free rent, waived deposits and fees, and free parking spots. So that will significantly reduce your annual rental costs. And also just use multiple search tools. Zumper is obviously a great source since we're all across the nation and in Canada, but using community boards, or if you're in an agent market, talking to brokers could be helpful. So you just are as informed as you possibly can before you commit to a long-term lease.
Crystal Chen, who is the Zumper spokesperson. Crystal, great to have you on here with us, talking all things rents. We got to see what we can do about these New York City prices. Too much. Thanks so much.
Thank you.
Certainly. Everyone, we've got much more on wealth after the break. You're watching Yahoo Finance. Picture this. You hop in the car after a busy day of work. You punch your address in to Waze or whatever app that you're using to avoid traffic, and connect your phone so you can play some music. All the while, your car's tracking every move you make. According to Counterpoint Research, 2 out of every 3 cars sold feature embedded connectivity. And this is expected to grow to almost 100% by 2030. And a Salesforce survey finds 65% of drivers are unfamiliar with the concept of a connected car. Internet-oriented nonprofit Mozilla spent over 600 hours researching various car brands' privacy and their practices. Here were some of the takeaways. We've got one of the authors of that report, Jen Kaltrider, who is the Mozilla Product Director of Privacy Not Included. Great to have you here on the show with us, Jen. I mean, what was the most astounding finding from the hours of research, hundreds of hours of research, that you put towards this study?
Well, the most astounding thing is that every car that people buy these days is bad for privacy. There are no good options for new cars for privacy for somebody who wants to go out and buy a car and cares about that. That was really disturbing.
Which of all of the vehicles that you studied was the worst at protecting privacy?
It was really hard to pick a worst because they were all pretty bad. Tesla, of course, raised a lot of eyebrows, but were they the worst? It's hard to say. I mean, Nissan said in their privacy policy that you had to consent to, they could collect information on your sexual activity. Kia said they could collect information on your sex life. Others talked about genetic information. So it's really hard to pick one. I think across the board, connected cars are all bad at privacy.
And so how can the connected cars, because, I mean, based on those surveys that we were just rattling off, it's not going to go anywhere anytime soon. How can they become better about protection of privacy?
Well, I mean, when you think about privacy, we're going to have to give up data in our connected world. It's just how it works. And what you want to see is a product that collects data only collect the data it needs to give you the service. So for a car, you want it to collect only the data it needs to get you from point A to point B safely, and then use it only for that. No other reason. Unfortunately, that's not what's happening with cars. Cars are collecting an insane amount of data. Some of it they use to get us from point A to point B safely, but a lot of it they use to make money off of us, to share for targeted advertising purposes, to sell to data brokers where insurance companies can scoop it up and raise our rates if it looks like we're driving poorly. And then there's the questions about, there's cameras in the car, there's microphones in the car, there's sensors, so there know how many people are in the car and how fast you're going and how hard you're braking and what you're listening to. And all that can be gathered to create these inferences about us that know, things like our intelligence, our abilities, where we go for dinner every Thursday night. And so it's all a big problem, and the solutions are way behind.
And so with that in mind, what are some tips for people who are trying to take it upon themselves to protect their privacy while engaging with a very connected, very highly technological driving and motor vehicle experience?
Yeah. So I bought a car last year as I was doing this research, and it was a scary proposition. But a couple of things that I did, and again, I kind of recommend these tips with the caveat that they're not all going to protect all of your privacy. You just can't do that with a car these days. But a couple of things you can do are don't download and install the app. It means you're going to give up some nice features like being able to remotely lock and unlock your car, or start your car. But it eliminates tracking. Don't connect your phone to your car. And I know that's crazy because you're like, well, how am I going to play my tunes or do my navigation? But that's a privacy choice that you're going to have to make. I choose not to connect my phone to my car. But again, it's not a great option. And unfortunately, none of the tips I give people are great options. And so I think the best tip I can give people right now is to call your elected officials and say, this is wrong. Our privacy is more important than car companies' bottom lines, and every connected big tech company's bottom lines. And we need a strong consumer-focused federal privacy law, which we don't have in the United States. And so pushing elected officials to make that happen would be maybe the best place consumers could start.
Absolutely. Jen, while we have you here, just last, it's summertime. We've got a lot of people traveling. Perhaps they're going to be renting a vehicle that has some of these features in it. I know I've been quick to say, all right, let me make sure that I can pair it with Bluetooth and make sure that I'm connected to, any type of AirPlay that might be taking place with that vehicle because I have a long drive ahead of me. What do people need to be remembering specifically for those who are renting a car out there?
Yeah, car rentals are really tricky because not only is that data potentially getting shared to the car rental company or the car dealer, the car company, but the next person that uses the car could see it. And so again, I recommend don't connect your phone to your car. Do it the old-fashioned way. Just keep your phone off of Bluetooth and unconnected and navigate and listen to your music that way. If you do connect it, do your very best to wipe everything that's connected off of the car, and that can be tricky. You can try and futz around with the settings and find a way to delete it, and then you just have to hope that it actually deletes everything. It might not. So I think your best bet when you rent a car is just stay disconnected. Do it the old-fashioned way. Keep your phone, and have a navigator over there, hopefully, to do that.
Yeah. All right, whipping out the old paper maps here. Jen Kaltreiter, who is the Mozilla Product Director of Privacy Not Included. Jen, great to see you here today. Thanks so much for the tips.
Thank you.
Certainly. Shifting gears here to an exciting new opportunity at Yahoo Finance. We bring in Yahoo Finance contributor Ross Mack. Now, Ross, You've got a brand new podcast out with Yahoo Finance with the first episode dropping noon Eastern time today. What can you tell us about the financial freestyle and the first episode?
Well, one, this is exciting, right? This is the first of its kind. And I just love the opportunity to really give the audience just a new way to actually think about personal finance, right? We're going to make this much more easily digestible. And the great thing about it is we're bringing in a lot of amazing people from all walks of life, whether it's C-suite employees at top financial firms, athletes, you name it. But the great thing is that we all have a commonality, and that is trying to make personal finance way more digestible, easy to understand. And let's just bring back that layer, right? We can't just continue to allow finance to be such a taboo topic that we talk about, right? Like, it's very important that we're talking about, tips on retirement, tips on real estate, tips on, the right accounts to open up for your children. And now you get to hear it from, some great people that I feel as though are, astronomically great at what they do. And the good thing is now they are helping, make it a lot easier for us to understand it, because what they've did along their pathway to finding success, they're willing to share it with the audience. And so I'm excited that we're launching today. And I think we should probably go into a clip of it right now.
Well, let's check out an exclusive clip, Financial Freestyle. Check it out.
Sitting here right now, 2024, still 40% of all Americans run out of money in retirement, right? 53% of African-American households run out of money in retirement. So we are looking at a system. If that system is broken, everything breaks down. So if your parents, can't run out of money in retirement, then you have to start funding them because they don't have money. So that's taking money out of what should be your, your nest egg, which you should be passing on to your kids. So it's just a generational deficit if we can't retire the right way.
Financial Freestyle with Ross Mac premieres today at 12 p.m. Eastern Time. We'll air a new episode every Monday. Ross, looking good. Thanks so much.
Thank you.
Certainly. Everyone, coming up, we've got much more wealth after the break. Stick around. The dawn of a new era for theme parks. Six Flags and Cedar Fair expected to close their merger today, and the combination of the two regional theme parks would create a combined entity valued at $8 billion. Shares expected to begin trading on the New York Stock Exchange as early as tomorrow, July 2nd. And our next guest sees meaningful upside potential for investors. For more on this, I'm joined by James Hardman, Citi leisure and travel analyst. James, great to speak with you and grab some time as always here. I mean, just the significance of this combination and what success looks like post-combination and deal for both of these companies now?
Yeah, I mean, it's a big deal. You don't see a whole lot of M&A in this space. I've been covering it for 15 years. This is far and away the biggest deal, really the only deal of its kind this century. And I think it creates significant value. You talked about, what success looks like. We think that value is created here, because there's a significant management upgrade, right? The Cedar Fair management team is the steady hand that I think these Six Flags assets have needed for so long, and has been missing. Ultimately, they've been doing this for a very long time. I think there's a liquidity upgrade, in addition to sort of bringing together two small cap companies to make them a mid cap company. Cedar Fair has historically been an MLP, which just a lot of investors just ultimately don't want to bother with. It's now going to convert to a traditional C Corp, which I think helps. And there's significant synergy opportunities here as well.
What does this mean for the consumer? I mean, a lot of households trying to figure out what theme park experiences are affordable for them right now as they're kind of picking and choosing where they can play in the experience economy. What does this mean for affordability once the consummation fully takes place here of this deal?
Yeah, I mean, I think there's going to be, in a handful of markets, there's going to be an opportunity to bring together multiple parks in a season pass structure, right? So I think maybe most notably of that Southern California market, if you live in Los Angeles and, you would consider going to either Six Flags Magic Mountain or Knott's Berry Farm, which is a Cedar Fair park. One of them is north of LA, one of them is south of LA. I think there's an opportunity there to get a season pass where you could get unlimited visits to both for a price that is probably going to be less than a single day visit to Disneyland. I think that's a big opportunity. Now, it's not, in most cases, there isn't a ton of overlap. And so the consumers aren't going to see much of a difference, but I think there are a handful of cases in which they will.
James, I imagine that, in your line of work, which sounds very fun as you're kind of looking across these theme parks, maybe you get to go to one from time to time in different markets and really perhaps put the experiences up against one another. What is the biggest value driver that consumers are really looking for from theme parks, especially in this economy?
Yeah, I mean, I think theme parks are, first and foremost, they're an experiential product, right? And what we've seen for at least the better part of the last decade is that experiences are winning out over consumer goods, right? I think in addition to that, it's a family-friendly form of entertainment. It's safe, which was certainly a big draw coming out of the pandemic. But ultimately, it's a way to take your family to have some fun, to unplug, so to speak. These are assets that aren't ever going to be, at risk from the Amazons and the Googles of the world, right? It's getting outside, it's having fun with friends and family.
Yeah, James, I've been bullish on Dippin' Dots since 2006, so hopefully that's holding up right now. James Hardiman, who's the Citi Leisure and Travel Analyst. James, thanks so much for taking the time.
Thank you.
Appreciate it. Well, July 4th is just a couple of days away, and while you may already be dreaming of sitting by the pool with a hot dog in one hand and a drink in the other, beverage companies are already out in full force, getting ready for the biggest beer day of the year. For more, let's bring in Maggie Timoni, who is the Heineken USA CEO. Maggie, great to have you here with us on the program. I imagine that your entire team is revved up for this 4th of July. What's going to look different from Heineken this year versus years past, and how does that play into the overall strategy that you're putting into the market?
Well, it's more of the same. We're focused on our core brands, Heineken and Dos Equis, and in particular over July 4th, we have Heineken 0.0, the #1 non-alcoholic beer by value in the United States, 5 points further than our nearest competitor. And we are making moderation cool. We are again up almost double digits again this year. The category is up double digits. And at the forefront of igniting this nascent category when we launched in 2018, we are here to stay, and we're looking forward to seeing more Americans choose a Heineken 0.0 over the July 4th holiday weekend, over the summer, and for the rest of the year.
How is Gen Z specifically and the customer lifetime value and relationship that companies like Heineken look to have with that consumer cohort and consumer group. How is Gen Z changing the appetite and the purchasing profile that you're seeing even from Heineken?
That's a great question. You know, we're seeing Gen Z, whether it's because of how they were brought up or if it's because of post-COVID, Gen Z is a much more thoughtful, intentional, but also promiscuous. They want to try new things. And if you look at the beer or the alcohol beverage basket, 94% of people who buy non-alcoholic beer also buy alcohol. So it's not instead of, it's in addition to. So we see Gen Z choosing moderation when they want to choose moderation, but all consumers are also in that space. So for us, it's great that we have alcoholic products and 0.0 Heineken 0.0 and also Dos Equis Lime and Zero Salt in order to offer an option for any occasion, whether it's Gen Z or beyond Gen Z.
When you think about production for Heineken, you know, there have been a few different things to have to wade through. There's sustainability. There's, of course, how you're being able to make sure that everything from the raw materials that goes into some of these beverages in a world that is continuously changing because of climate, how you're able to make sure that you're able to kind of continue putting forth the same operation, but with a more kind of environmentally sound footprint as well. How do you navigate that right now, and what are the changes that Heineken is making?
We're very intentional with corporate social responsibility. We're making moderation cool. We're looking at net zero. We're refining and looking and tweaking our breweries and building new breweries that are much more sustainable. For Heineken 0.0, we're ensuring that we deliver sustainable, socially responsible product to the United States, but also around the world. We launched in 2017, and we're in over 100 countries already. We are the #1 non-alcoholic, zero alcohol brand across the world.
Just lastly, we only have 30 seconds left here. What is your anticipation for how canned cocktails are going to continue to perform for Heineken?
We don't, well, in the United States right now, we don't have canned cocktails. We do see that spirits are growing because of canned cocktails. Outside, if you exclude ready-to-drink cocktails, spirits are declining. We see a little bit of softness in the canned cocktail space over the last 12 weeks. So let's watch that space. We know what happened seltzers.
Certainly. Okay. All right. Yeah. I'm looking at the cans that were behind you, and I was like, oh, you know what? That is another major trend that's really come about within the industry, and no doubt top of mind for you and the team there. Maggie Timoni, who is the Heineken USA CEO. Thank you so much for taking the time, Maggie.
Thank you so much, Brad. Thank you.
Absolutely. That's it for Wealth, everyone. I'm Brad Smith. Thank you for watching. Stay tuned for Market Domination. Shauna Smith and Josh Lipton. That's coming up at 3 p.m. Eastern Time. You don't want to miss it. Oh.